would you please? Okay, Cody, would you go ahead, please, and unmute yourself and give us your introduction if you're there. Cody, go ahead. All right. All right, Haley. Well, Haley's, okay, hold on. Haley is in the chat. Hold on a second. Okay. All right. Now, Haley, it looks like is, let's see. Okay, she's going to be typing in today. Okay, so she'll be on the chat. Okay, hold on. And this is fine. I participate regularly with sessions using Zoom where once again there's audio and people in the chat simultaneously. Okay, so Haley is from, and I don't know if I'm pronouncing this right. Go get Beak Range Bank, and she's a credit analyst, Ironwood, Michigan. Okay, all right. So I think, if I'm not mistaken, she's up in the UP. Okay, Ironwood. Yeah, but not far from Iron Mountain. But if you can clarify if I'm right on that, Haley, that would be great. And her skill set, she works, let's see, she's a skill set of a 7. Okay, so excellent. All right. And excellent. Thank you for that introduction, Haley. And all right. Now, next individual is Kobe. Kobe, please, I can see you've got your audio. If you can please unmute yourself. Okay. Okay, and she says, Haley says, I apologize. Go get Bick. And yep, she says she's in the UP. Excellent. All right. Thought she was in the UP, Ironwood. All right. Now, Kobe, can you unmute yourself and give us a quick introduction, please? Okay. All right. Kobe, I can see that you've got the audio. All right.
Okay, can you hear me now?
Oh, I can hear you now. Excellent, Kobe. Go ahead, please.
Yes, I'm with North Point Bank. I've been with North Point for 2 years, but in the banking industry for over 20. So loan officer originally, now I'm a personal banker. So I do have some knowledge of the tax returns.
And what number would you give yourself?
Like a 6.
Okay, excellent. Thank you, Kobe. And we have Cody and we have Kobe. So I'm going to have to make sure I pronounce those clearly as we go through. But thank you, Kobe.
You're welcome.
Oh, and once again, what town or what city you're located in, Kobe?
Oh, Grand Rapids, Michigan.
Okay, you're in Grand Rapids, and I'm trained in Grand Rapids. You bet. Beautiful city. River rolls right through there. Wow. Okay, excellent. Thank you so much. Okay, now moving right along, and back to Haley. She's definitely in the UP. You've been a couple hours from Duluth, and thank you for that. Excellent. Okay. All right, now let's move forward. This is Heather. Heather, I can see you. You should have the audio. If you'd unmute and just give us your introduction, please.
Yeah, hi. My name is Heather. I'm with Crestmark Bank. I'm an account executive. It's a role that's fairly new to me in the last couple of months, although I have been with the bank for 15 years. I am in New Haven, Michigan. And
pardon me, you said New Haven?
Yep.
And what part, just for my benefit, what part of Michigan?
It's probably about 20 minutes out from maybe Port Huron. Do you know where Port Huron is?
Okay, yeah, okay.
Yeah, about 20 minutes from there.
Great. All right, and keep going. Sorry, go ahead.
Oh, that's okay. And then I have worked with tax returns in the past. So but just a little bit. So I would say maybe like a 3 or a 4.
Okay, excellent, a 3 or a 4. Thank you, Heather. And let's see. Now, Heather, I understand you're with Crestmark, right?
Correct.
Okay, and then evidently there's several other people in your group. Do you?
Yeah, there should be 6 of us.
Okay, I'm just gonna open it up for the Crestmark people because I don't have your name specifically on the list. It's just that we're gonna have a group. I did have yours, Heather, but can we go ahead? I think there's just if you can just shout out if you're with Crestmark so I can get your introduction. So we have you and we can have you participate throughout the session. Go ahead. I think there's Christian and there's other individuals. But go ahead, please.
Hi, I'm Christian with Crestmark. I'm in the lending division, working in the solar portfolio.
Okay, and if you can give us your full intro, please. We got your name, your bank. What do you do in the bank specifically? And what town are you located in? And then lastly, on a scale of 1 to 10, 10's the highest, 1's the lowest. How would you rate your skill set with tax return analysis, please?
Sure. My name is Christian Kazalia. I'm from Chicago, born and raised. I'm an account executive, and I work with the solar portfolio, Crestmark solar portfolio. And ranking-wise, maybe 6 or 7.
Okay, 6 or 7, and you're actually based in Chicago right now, correct?
Correct.
Okay,
Correct.
great. Okay. Anyone else from Crestmark? There should be several more people from Crestmark. Go ahead, please. Okay,
I can go next.
okay, and just shout out, tell us your name, and if you can do the full introduction, please.
Sure. My name is Anar. I joined Crestmark just like a little bit over 2 months before, and I'm working as a financial analyst at Crestmark Bank.
Okay,
I live in Royal Oak, Michigan, and I go to Troy location.
okay. So
Yeah,
in the Troy location, excellent.
yes,
And can you spell your first name? I apologize. Can you?
sure. It's A as an apple, N-A-R, Anar.
A-N-A-R?
Yes, yes,
Anar, okay,
yes.
Anar, great.
Yeah.
And what's your number? What number would you give yourself with tax?
Yeah, so at the moment, I would say around 6.
Okay, excellent.
Yes.
Thank you, Anar. Thank you.
But just want to add one more thing that I think this training is going to help me a lot since I have to analyze this tax returns on everyday basis. So I'm really looking forward.
Okay, great. Thank you. You bet. And this will help because we're gonna just nitty gritty, I mean, we'll keep it light, but we will cover the tax forms and the quote unquote, the cash flow,
Yes,
procedures,
yes.
if you will.
That's
Absolutely.
literally I do every day. So I'm
Yep.
really excited. Thank you very much.
Oh, you're welcome.
Thank you.
Okay, now let's see. Anyone else from Crestmark? We've got Heather, we've heard from Christian, Anar, anyone else from Crestmark?
Yeah, hi, my name is Michelle. I'm also from Crestmark.
Okay, okay, play. Okay, let me write this down.
Yep.
I've got to add you to the list. So Michelle, and you're also with Crestmark. And where are
Yes.
you physically located?
In Troy, Michigan.
Okay, also in Troy. Okay. Then I know Troy. I've actually trained there.
Nice.
So the CPAs there, excellent. And what do you do in the bank and what's your number?
I'm an SBA underwriter within the bank, so I work on majority SBA loans transactions. I would say
Okay.
between like a 7 and 8.
Okay, a 7 or an 8. Good. Thank you, Michelle. Excellent. Okay, we've got Heather, Christian, Anar, Michelle. Anyone else from Crestmark? There should be a couple of more. There should be a couple more people. Anyone else from Crestmark? Okay. Okay, well, we'll go ahead and get started. And as a follow-up, let's see, has Cody, Kodee, joined us? If you can preferably on the audio, but if you can't access the audio, if you would just join us, if you can just type into the chat. Is Cody with us? Kodee. All right. Okay, well, I'll come back and check, when we take our first break, check and see if there's anyone else has joined us. But welcome, everyone. I'm going to go ahead, pardon me, and pull up the main PowerPoint. So give me just a second here. All right, there we go. Excellent. Okay. And let me just start that. Excellent. Okay, now, I do appreciate each one of you attending today. My name is David Osborne, as Stephanie, our administrator, has mentioned, and it's great to be in today's session. Now, I've already kind of explained a little housekeeping. We'll take our 2 breaks in the morning, 2 breaks in the afternoon, half-hour lunch. Also, once again, if you can keep your phone line open, if you're on the audio, that's great. If you've got background noise, then of course we need to have you mute that. But I do want to emphasize this is going to be a live interactive class. This is not just a straight lecture. And I do webinars regularly, pardon me, that are hour and a half, 2-hour length. And those type of settings are just straight lecture. I mean, there can be some questions, but it's not interactive. Today is a full day class. Today is literally the mirror image, as if we were either in Lansing, and I do train for the Michigan Bankers Association, MBA, regularly, and for many years, as Stephanie mentioned, in Lansing, and then also up in Marquette in the UP. And we've even done other locations, UP and Gladstone and so forth. So, but it's great to be with each one of you. Okay, we've got another comment. Hold on, within the chat. Here we go. All right, Haley, love Marquette, you bet. And this is now by way of introduction. I am a business trainer, a contract CFO, and a college professor. And so I provide training primarily for 4 groups: the bankers, the CPAs, the attorneys, and number 4, credit managers. Credit managers are credit professionals within a corporate setting. So I train them. These are individuals that usually report to the CFO of the company. They underwrite the larger receivables. And then obviously a certain percentage receivable, just like your loans at your bank, go bad. Well, they collect on the back end. And so they're almost like a mini commercial lender, sort of, within a corporate setting, and work with that group as well. Also, by way of introduction, pardon me, I am a former banker, former commercial lender, managed a commercial lending team at one point in time, worked at Bank of America, obviously one of the largest banks in America, but also worked at 2 community banks. Okay, what we're going to do now is we're going to do a class shout out. Whoa, what's this? Well, I'm going to call on you, and we'll, as you've seen, and most of you are audio. You can participate through the audio. We do have Haley through the chat. No, that's great, but and please just allow her to do the chat. Everyone else participate on verbally or audibly. Now, I do want to emphasize as we move forward through the material, we will emphasize this, of course, from the bank perspective, commercial lending. All of you are involved in commercial lending in some way, shape, or form. And as I mentioned in my background, commercial lender, big bank, but I also worked at 2 community banks. And what I'd like to have you do now is just do a shout out. Everybody has the mic, and of course, Haley, through the chat, yes or no, just shout out, unmute yourselves, shout out Yes or no? Do you work at a community bank? Is your bank a community bank? So everybody, this is called a class shout out, and you'll hear me do this periodically throughout today's session. Now I'm going to call on you individually as well, extensively, but we'll participate also as a class where we do these shout outs. So the first shout out of the session today, yes or no, do you work at a community bank? Everybody, if you would unmute simultaneously, and Haley, if you'll respond through the chat, yes or no, please. Do you work at a community bank? Everybody, if you just unmute yourselves and shout
Yes.
out.
Yes.
Yes or
Yes.
no, yes or no, yes. Keep it going, everybody, everybody. We want everybody. Okay. All right, excellent. And Haley says yes as well. Excellent. Thank you, Haley. All right, well, let's move forward. If you'll turn with me to this next page, this is my bio page. We just reviewed that. And I do go all over. I do want to emphasize, traditionally pre-COVID, I go all over the country, ground-based. Now with COVID, mainly webinar-based, Zoom-based, whatever, however you want to describe it. A lot it's a Zoom, or there's several other platforms I train under, but meaning go to webinars and so forth. Well, I do want to emphasize, believe it or not, in the last 3 weeks, I've been on the road 3 times. As the states are starting to, the numbers with COVID are starting to change, and the removal of the mask and so forth. I've actually been on the road 3 times, at once every week for the last 3 weeks until this week. And then I kind of go dry for about a month to the end of June. Now I'm doing webinars every day, but back on the road. And so I'm starting to go back on the road, similar, but not nearly the level, of course, as before the pandemic. But I do look forward, as Stephanie, our administrator, mentioned, look forward to having, the classes in September. And we do have 3 classes in September, and I'll go through those later in our session today. So you can write those down and kind of emphasize, and you will all receive emails detailing these 3 sessions in September. Hopefully, and they'll be in Lansing. Hopefully we'll be there together physically, or ground-based, if you will. I am based in Las Vegas, as you can see, and as was mentioned earlier. I lived in the Las Vegas market for many, many years, over 30 years, 33 years actually, and but grew up all over the world. My father was career military. Now you're all in the upper Midwest, of course, from Chicago up in Michigan, even to the UP. Actually lived in Ohio twice as a young kid, and then also Illinois. So it's my background, if you will. You can see bottom left-hand side further, if you would highlight dlosborn@cox.net. My last name is unusual. It's Osborne instead of the more common Osborne with an ORN. If you have questions in the session today, please don't hesitate, stop me. Just say, David, just shout out, just say, David, can I ask you this question, what have you? And as you can see, as I mentioned, this is live interaction, and I will be asking you questions, and I'll just go right through the list, including Haley in the chat and everybody else in the audio, if you will. So this is live interaction. Now, please take note on this as well, especially the subject of tax. It is so comprehensive. It is so much to it. A week from now, you're working on a loan request. A month from now, 6 months from now, a year from now, you have a tax question. Do not hesitate. Reach out to me. Number one, I keep everything confidential. In fact, what I ask of you to do is to take the tax return that you're working on, that you have a question on. And this is, a week from now, a month from now, 6 months from now, from right now. Take the tax return, copy it. Take your marker, black out name, social security number, address, any confidential information. Scan it and email it to me with your question or questions. I receive emails regularly from lenders, credit analysts I work with, loan officers, you name it, from all over the country, whether it's webinar based or ground based, doesn't matter. The biggest set of questions, not surprising, is from today's session. Now, I do provide an advanced tax class as well. Today's basic. In September, we'll do that. I'll outline that later on. Well, taxes, it could be tough. Don't hesitate. Number one, I keep everything confidential. And I've had this happen a couple of times. The lender, credit analyst, you black everything out, and then I'm pulling up on my screen, and then I get to the last page, and they miss the last page. Meaning, the last page is there, but the name, social security number, address of the customer is right there on my screen. Meaning, they for whatever the page is stuck together. I don't share that with anyone. Completely confidential, number one. Number two, I don't charge for this. I consider it as an extension of today's session. And number three, I do receive emails regularly, especially on this topic. This is the number one topic that I receive emails, including just a few days ago from an attendee of one of my previous tax classes. So please keep my contact info and use me as a resource. Now, one last thought, we move on. If the tax issue is quite complicated, or I determine, boy, one or two or three little paragraphs in an email reply is not going to do it, I will actually call you, and I do this regularly. And you'll have the tax return, either the hard copy in front of you or on your screen. I have it on my screen, and we just walk through it together verbally, because sometimes it's more efficient to do it that way than to compose a 3 or 4 page email. Of course, if it's 1, 2, or 3 small paragraphs explaining or clarifying this or whatever relative to your issue that you're looking at or working on. But I often will call, especially with tax, because it does get very complicated. Okay, with that, if you'll move forward, page number 3, the top left-hand side of this page, if you'd please add this to your notes, okay? Today's session, we're going to cover 4 areas. Number one is tax forms, both personal and business, tax forms. Number 2, cash flow analysis, both personal and business, cash flow analysis. Number 3, miscellaneous. Number 3, miscellaneous, little miscellaneous section. We've got several different models thrown in together, kind of a little miscellaneous section. Pardon me. Lastly, number 4, tax updates. Tax updates. Now, we're not going to wait till the end of the session to do the tax updates, but we have a separate PowerPoint presentation at the very end, which we will turn to. And in that PowerPoint presentation, we will summarize the class / do even further updates, summarize the updates. But we're going to start even as we get into this material in just a moment. Now, so 4 distinct sections: tax forms, cash flow, miscellaneous, tax updates, which is huge because there's been so much change to the tax code. And I'll just say it straight out, and we're going to see this later in Exhibit 3. Much of it driven because of COVID. Extensive, which in my opinion, you should be aware of it to the detail, because you have clients ask you. You're their lender, you're their credit analyst, whatever. You work with your lenders now, or your borrowers. Now, you should have available the main PowerPoint, which is right in front of you on the screen, and 3 exhibits. Exhibit 1 are the personal tax forms. Exhibit 2 are the business tax forms. Exhibit 3 are the tax updates, as I mentioned. So this is how we'll work it. We're going to cover a section, like we're writing it right here, on the personal tax form. This is the format of the 1040. And in a moment, we will get to the cash flow of the individual or personal. Then we will go out to exhibit number 1. And you'll hear me say, I'll clearly, so you won't be lost. Just say, hey, put the main PowerPoint to the side, take out exhibit 1, put that right in front of you. Then we will go through exhibit 1 detailed. You'll see me turn the pages on your screen. You'll have the hard copy in front of you. And I beg of you, before we forget, if you haven't done so, grab a highlighter, grab your pen, because I encourage you to take a lot of notes, especially when we get to the tax forms. Okay, and then keep the material. Keep all of this material after the session in a binder so you can always reference back. Then with the after we do the personal tax forms, we will go back to the main PowerPoint and shift to the business side of the equation. Do the business tax forms, then the business cash flow, then go back out to exhibit number 2, go out to exhibit 2, the business tax forms themselves, then go back to the main PowerPoint, do set number 3 or section number 3, the miscellaneous, and then go out one more time to exhibit 3 and stay on exhibit 3 and conclude the session with the tax update summary of the class. So I know it's going back and forth, but you'll be able to follow it, because I'll just remind you and say, hey, do this, and if you'll just, all I beg of you to do right now is to have the main PowerPoint in front of you and 3 exhibits off to the side. And I'll help you, guide you as to, which to flip back and forth. Of course, you'll see it on the screen, but it's going to help you as we go back and forth through the material. It's just because, of course, the tax forms are so comprehensive and large too. You'll see, of course, you've printed them out, you'll see, and you've already seen it, if you will. Okay, now, one last comment, we move forward. And there's a lot of prep for this class because there's so much detail in kind of the system, if you will. But one last comment, and then we jump in to page number 3. The tax code is very, very political. The tax code is not made by the IRS in the US. The tax code is created or made and modified and updated and changed by the US Congress. It is the US Congress that makes the tax code and modifies it. The IRS is a division or department underneath the Treasury Department. It's a division of the Treasury Department or Department of Treasury, federal agency. The IRS helps, number 1, manage the tax process, and number 2, collects. But a lot of people, including myself, sometimes I'll bash the IRS and then I catch myself and I say, oh, wait a minute. It's not the IRS, it's the US Congress. So I emphasize I am politically neutral in all of my training. Not only tax, today's theme, but even other subjects. Oh, all of it. But tax is the most politically based of all my training for the bankers. Oh, absolutely. And it's because it's made by Congress. It's a political body. I don't take the Democrat side. I don't take the Republican side. I don't take the independents, the Tea Party, the Green Party. I don't take anyone's side. I am simply the reporter. I am reporting the facts. But much of what we'll talk about today is political, including towards the end of the session in Exhibit 3, the tax updates, the recent tax updates, including in the era of COVID. Oh, very politically laced, but I'm not political. I'm just going to be reporting fact. You, from a political standpoint, you have all your opinions you would like. That's fine. course, my opinion, this is my opinion only, my recommendation. When you deal with your borrowers, your commercial borrowers, I would be politically neutral as well. That's my opinion and recommendation. Now that's broader than even the tax code, just in general, because you never know. You may be a Democrat and think, oh, they're Democrats, they're not, and or they're Republican, you're Republican, whatever. You just, in my opinion, you just keep it neutral, if you will. Now, having said that, I will report the facts, including the most updated tax code change in America took place March 11th of 21. President Biden signed it into law. We will see it later in Exhibit 3 towards the end of today's session. But it is all, it not all, it is heavy political, the tax code, absolutely. Now, putting that aside, but that's an overarching theme. Let's go into the tax form, the 1040. Once again, if you've got your highlighter, you can see we're in the tax form itself. These are the main component parts of the 1040. We've got name, address. We used to have exemption. To the right of exemption, if you'd please put 2017, 2018, this is on the top right of this page, 2017, 18, and 21. Okay. 2017, the exemptions were $4,050 per person. So we're going to use a make-believe couple, Bob and Sue. Bob and Sue. They have a make-believe business, ABC LLC. Okay. ABC LLC. They are based right outside of Detroit. Okay. They own a small manufacturing firm, ABC LLC. They're just on the outskirts of Detroit. It's a light manufacturing firm, not heavy industry. They've had it for many years. They've been your customer at the bank or a bank customer for many years. They have a CFO by the name of Jane. Oh, she's good. You'll love working with Jane. All the tax returns are timely, financials, just any question. I mean, it's great. They have an independent CPA by the name of George. George is good. You love working with these people. It's just a good relationship. Now, is it perfect? No. Are their numbers perfect? No. Have they had losses? Absolutely. What about the era of COVID? Well, believe it or not, the era of COVID, they actually have done well. Why? Because their plastics, part of their manufacturing process is plastics. And when COVID hit, they did quite a bit of plexiglass, for security, and like a bank, plexiglass for the teller line and so forth. Those are obviously very thick, bulletproof or whatever. But when COVID hit, they geared up and started producing, the plexiglass we see everywhere, in your bank even, and everywhere. Even as the masks come off, they're still there, and so forth. So they're doing quite well in the era of COVID, believe it or not. First couple of months, like a lot of businesses, kind of hesitated, like, whoa, what's going on? Like a lot of people, most everyone, a little hesitation there. So Bob, Sue, company ABC LLC, Jane's the CFO, George is the independent CPA. Bob and Sue have two dependent children. In 2017, it'd be 4 times $4,050. I'd add that to your notes. 4 times $4,050. In 18, 0. In 21, 0. Why? Because of the TCJA. Top right-hand side of this page, if you would please write in your notes, TCJA stands for Tax Cuts and Jobs Act. Tax Cuts and Jobs Act. Now, what is this TCJA? Well, it was signed into law December of 17. So it's known as the Tax Cuts and Jobs Act of 17. But for most of the provisions, they kicked in 1/1 of 18. It was the most massive overhaul of the US tax system in over 30 years. The most recent since then was in 1986, and it became law in January of 87. Who was the president of the United States and signed that into law? Ronald Reagan. Now, who signed the TCJ into law? Donald Trump, President Trump. Now, this is not a political statement. This is a fact. This is just a factual statement, just to illustrate how politically laced the tax system is. If you heard President Biden speak about, what was it, about 3 weeks, 2.5, 3 weeks ago, whatever, he criticized, slang term, quote unquote, slammed the TCJA, Tax Cuts and Jobs Act. He did in his speech in front of Congress, less than 3 weeks from right now ago, 2.5 weeks ago, whenever it was, just a couple weeks ago. I'm not making a political comment. It's just a fact. It is a fact. It was the most massive overhaul to our tax system. And what we're going to talk about today is heavy TCJA, Tax Cuts and Jobs Act, because it is the law today. Even though the current president of the United States, quote unquote, criticized it openly, slang term, slammed, quote unquote, slammed it, it's still the law. Now, fast forward, the most recent tax law change, March 11th of 21, was signed by President Biden. So, both major parties, have influence, of course, on the tax code. It's the law. Because once again, it's not created by the IRS. Oh, no way. It is the US Congress. Okay. But this was a massive change, going back to exemptions. This like most tax people, what? What's going on? And let's go to this paragraph number 2 in the form. In the 1040, you see, of course, and we'll see this in just a moment, just a few minutes in Exhibit 1, wages, salaries, interest, dividends, and so forth, alimony receipt, on and on. This is the income to Bob and Sue personally. And by the way, before we forget, kind of alluded to this a moment ago, the personal tax form with all the numerous schedules, including the K-1s that we'll tie in later, is much more difficult by far than the freestanding business tax forms from such as an S Corp or a C Corp or an LLC. Kind of interesting. Paragraph number 3. We now knock down the tax. Look at educator expense. I put $250 right next to educator expense. Now, what do I mean by $250? Well, Congress years ago, way before COVID, they decided as a body, both houses of whatever, the House and the Senate, whatever, they decided to give, and both main political parties and independents and whoever else, give the teachers a tax break, K through 12. The average school teacher in America will spend anywhere from $1,000 to $2,000 a year, never to be on their classroom, never to be reimbursed by the school, by the parents, the school district, no one. So Congress said, we're going to give them a break. And by the way, that's changed a little bit because of COVID. If a teacher in America today, K through 12, oh, and by the way, it doesn't matter if it's public, private, charter school, doesn't matter. K through 12 though, not college age and so forth, or college level. No, K through 12 only. Well, with COVID, if a teacher spends money for, a mask, whatever, or the plastic shield deal, whatever, those dollars can be included in that $250. How about IRA deduction? This is another adjustment or knocking down the gross income downward. If you add this to your notes, 2021, right now, this year. By the way, we just finished last week, the tax season, because it was extended a month. Last year, it was 3 months extension. So we just finished it on the 17th, just last week. Now, IRA deduction in 21, meaning this year we're in now, which for the tax preparers, they're still coming down from the tax season, so to speak. They won't touch until spring of 22 for 21, but we need to talk about this year because it impacts the next cycle. We're starting into the next cycle, if you will. $6,000 per person maximum IRA deduction in 21. But if the individual is age 50 and above, I would add this to your notes. Pardon me, if they're age 50 and above, you can add an extra $1,000 for a total of $7,000. What's the extra $1,000? It's called the catch-up provision. Catch up. What are they catching up for? Retirement. They're catching up for retirement. Okay, now alimony paid. You see alimony up above, received in paragraph number 2. And third paragraph, alimony paid. Now, this is a radical change in the tax code. You should be aware of it. I personally don't believe this had received that much, publicity, if you will, but it should have more, in my opinion. Up until the TCJA, alimony received was taxable. Alimony was paid was tax deductible. With the Tax Cuts and Jobs Act, alimony received is not taxable. Alimony paid is no longer tax deductible. It's neither. It's become like child support. I would add that to your notes. This is huge. It's become like child support. Child support is neither taxable nor tax deductible. Now, this was a weird part of the TCJA. Even though it became law 1/1 of 18, this aspect was delayed for an entire year to 1/1 of 19. So I'd add that to your notes. So this part of the Tax Cuts and Jobs Act did not kick in until 1/1 of 19. Now we're going to see on the 1040 momentarily that you can still have alimony received, alimony paid, like the old system. Because if a couple divorced, like say they divorced in 2015, and it's a 10-year plan or a 20-year plan even, well, it's still in effect. So they're essentially in that situation, they'd be quote unquote grandfathered in. Okay, now we're going to do a quick activity. I'm going to call on a few of you. We don't use the word alimony in the bank. I beg of you, do not use the word alimony. The word alimony has become a profanity in America. What? What do you mean by that? It's become like a swear word. Now, it's kind of weird because it's still right on the tax form, which we'll see momentarily. But to your clients, to your customers of your bank, I beg of you, do not use the word alimony. They may even look at you like, did Haley just swear? Did she just swear? There are 2 phrases we can use instead of alimony. Everybody take just a moment. Write these down. Write these down if you would. Write these down if you would. What are the 2 phrases we should use instead of alimony? I mean, it means the same thing, essentially, but there are 2 phrases. Take just a moment. Write them down off to the side. Then I'm going to call on you. Okay, take just a moment. What are the 2 phrases that we can use instead, and we should use, one of the 2 or both, instead of the word alimony? Okay. Haley, if you can type into the chat and tell us your thoughts. What are the 2 phrases, if you would, please? And while we wait on that, Kobe, can you give us one of them? Kobe? If you can unmute unmute your line.
Spousal support.
Spousal support, you hit it. Excellent. There's one of them. Excellent. Pardon me 1 second. Hold 1 second. Thank you. I had to sneeze. I apologize. It is allergy season. Oh, to the max. Oh, it is allergy season, including in Vegas. We've had a really weird spring, a lot of wind. We always have wind, but excessive amount of wind and weird temperature swings. Extreme. It's really different spring. So spousal support, excellent. Thank you, Kobe. Heather, what's another one? Can you think of the other phrase that we would use? Spousal support is one. What's another one? Heather? Any ideas? If you'd unmute yourself. So we've got spousal support. What's another one? Okay. While we wait for Heather, Christian, how about you? How about you? Any ideas? Christian, spousal support is one.
I'm not
Okay.
sure. Drawing
Okay.
a blank.
No problem. Okay. Haley says in her comment, she says ex-spouse support. Well, spousal support, good. Thank you, Haley. Comment on the allergies as well. The other one is separate maintenance agreement. Separate maintenance agreement. If you'd add that to your notes, please. Okay. So spousal support or separate maintenance agreement, or you can even use them both. Excellent. Now, let's go down to paragraph number 4. We take our gross income, we adjust the gross income down. We now have adjusted gross income, or AGI. Then in the 1040 tax form, we used to itemize, which is Schedule A. It right under itemized deductions, if you put Schedule A, and if you would put these are the big 3 on Schedule A. Now we're going to look at Schedule A's in just a few minutes, but let me give you the big 3 items. Number 1 on Schedule A itemized deductions. Number 1, the mortgage interest on the primary home or residence. The mortgage on the primary home or residence. Number 2, second major item, the real estate tax on the primary residence for Bob and Sue. Their home, not a rental, their primary home or residence. Number 3 on the itemized deductions, charitable donations. Charitable donations. Okay, now, what about standard deduction? With the TCJA, the standard deduction completely changed. Radical. Underneath standard deduction, we're going to build a little table, if you would, a little chart or table down below. Right below standard deduction, if you would please put 17, 18, and 21. And all we're doing is 17 before TCJA, 18 right after, and then fast forward to this year we're in now, 21, like we did before up above with the exemption, 17, 18, and 21. And then that's on the horizontal, right below standard deduction. And then on the vertical on the left, maybe below the S of standard or below the word or, if you would please put MFJ, married, finally, jointly, and then right below that, SF, single filer. Married filing jointly, MFJ, and then SF, single filer. Okay, now, let's fill in the table together. In 2017, married filing jointly, the standard deduction was only $12,700. $12,700. What about in 18? After the TCJA kicked in, radical change, 24,000, almost doubled. So 12,700, 24,000. What about fast forward to right now, 21? $25,100. $25,100. Okay, let's go to single filer, SF, and fill in the chart or table. 2017, 6,350, 6,350. In 18, after the TCJA kicked in, 12,000 even, 12,000 even. In 21, 12,550, 12,550. So essentially doubled. Radical change. But remember, there's no exemptions up above, which we'll see on the next page. I'll show you where it used to be, of course. So that's a radical change. Okay. Okay. Okay, Heather, thank you. Heather just notified me she's got a technical issue. Thank you for that. I've got your message. By the way, if any of you lose connection with the Zoom, my recommendation is go back out and just come back in. A lot of times I find that will fix it. Excellent. Thank you, Heather, on that. Okay, now, before we move forward in the tax form for the 1040, just to clarify, we traditionally will take the higher of the two, the itemized or the standard. It used to be when the standard deduction was so low, most of your borrowers, your commercial borrowers, would itemize Schedule A. But now, because the standard deduction is so high, why mess around with itemized deductions? We're just standard. You take the higher of the two. Now, I recognize that many of you are already using, of course, the 2020 tax return in your cash flow modeling, 18, 19, and 20. So everything is post TCJA, meaning 2018 on. But some of you don't have the 2020 tax return, and or Bob and Sue, whoever you're dealing with, ABC LLC, Bob and Sue have gone on extension. They didn't file by last week, by the 17th of May. Oh no, they went on extension. So for the next few months anyway, you're going to be using still 17, 18, 19. So you look at a 17 tax return, well, that's the old system. Many of your customers did itemize, but not today. Just a thought. Let's move forward to page number 4. Now we're still on that 1040. We're still on the 1040 format, general format. This is where, if you look at the top of page 4, this is where you would insert, or we used to insert 2017, 16, 15, all the way back, the exemptions. So I put in your notes next to the word eliminated, 4 times $4,050, meaning Bob and Sue and their 2 dependent children. That knocked this tax down significantly, but the exemptions are gone. So I would just highlight the word eliminated. Absolutely. Now we arrive at taxable income in the 1040 tax form. Based upon the taxable income, so much tax. Tax minus we'd say, okay, let's say they owe $10,000 in tax and they've withheld 15. Well, they paid over. They're going to get a refund of 5,000. They owe 10, they had withheld 15. What if they owe 10? Based on the taxable income, they owe 10,000. They've only withheld 5. They're going to owe 5,000. Pretty straightforward. Now, because the vast majority of your borrowers, of course, are self-employed, they are not like you are, where you get a paycheck, twice a month or every other Friday or whatever at the bank, and then there's a certain amount of money taken out for tax. No, Bob and Sue are self-employed. They have their LLC. They must send in what are called the quarterly tax withholdings. What are the dates? To the right of the word withheld, if you would please add this to your notes. there are 4 quarterly reserve payments due. Give you the first one, April 15th. What I'd like everyone to do is spend just a moment on this. Take a stab at this. What is the second one, the third one, the fourth one? These are crucial to, in my opinion, this is crucial for you to know as a lender. Because when Bob and Sue, you're with them at lunch or on the golf course or in your office or their office, and they say, oh man, we got to write another one of those quarterly withholding checks. See, because they do it all in one quarter, in one shot. They don't, it's not like, you know, twice a month or every other Friday with the paycheck. No, it's a bigger check and it's once a quarter. So take a moment. What are the other 3 quarter dates? The first one I gave you, April 15th. Just take a stab at it. Just take a kind of a estimate, you know, guesstimate what that is, if you will. Take just a moment. We'll come back together. What are the other 3 dates? The other 3 quarterly dates for the year? Okay, here we go. Anar, can you give us the second one? Just take a stab at it. What do you think the second date is?
July 31st.
Okay, July 31st. That's not quite right. Michelle, what about you? Any ideas? Michelle?
15th.
What, pardon me again?
July 15th.
July 15th? No. These are odd. These are odd. June 15th. In fact, it's coming up on a little over 2 weeks. So April 15th, June 15th, September 15th, and January 15th of the next year, but for the previous 4th quarter. They're odd. They're kind of weird. They're odd. Once again, April 15th, June 15th, September 15th, January 15th of the next year, but for the previous 4th quarter. Now, what is the worst day of the year when it comes to taxes for Bob and Sue, the self-employed? You all work with Bob's and Sue's of the world. What's the worst day of the year by far, tax-wise? If you'd add this to your notes, April 15th, please. Why April 15th? Well, if Bob and Sue owe money from the previous year end, let's say, you know, their year ends 12/31, December 31st. When is that due? When is it due? April 15th. Even if they go on extension, people don't realize this. Oh, I'm going to go on extension. You think, oh, they don't have to pay till October 15th. Oh, no. April 15th, they must pay. In fact, if they short it too much, they're going to get penalized, tax or interest and penalties. They have generally up to 85% accuracy, meaning if they're off by more than 15%, they're going to get quote unquote dinged by the IRS. So April 15th, the first or the check owed for the previous year end. They just didn't pay quite enough in, whatever, made more money than they thought, whatever their numbers were off. Or they owe money. They didn't even it out. They didn't strategize to where, they're just break even. No, they owe, 5,000, 10,000, whatever it is. April 15th for 12/31/20 year end, or 12/31 of 20. Second check that they have to write, and these are 2 different checks sent to 2 different departments at the IRS, is the first quarterly reserve payment, April 15th for the new year. Wow. So April 15th for your small to medium-sized business borrower can be a tough day. 2 different checks sent to 2 different departments at the IRS. Now we make the checks payable to the U.S. Treasury. Years ago, we used to write checks to the IRS. It was literally Internal Revenue Service. Oh, no, not today. It changed several years ago. Why? Well, to recognize we're not paying the IRS, we're paying the US Treasury, the US. Just a thought. Any questions? Haley, any questions so far? You'll type into the chat while we wait on that. Kobe, do you have any questions so far? Kobe, any question?
No, not at this time. Thank you.
Great, you're welcome. Haley says none as well. Great. Now let's go further on the forms. Several of you may have completed a 1040 EZ. Now it's eliminated with the TCJA. So starting 1/1 of 18, it's gone. And it's gone today, 21. Fast forward to today. Took 10 minutes to fill out. We need a class shout out, a quick class shout out. Yes or no? When the 1040 EZ, which was a real simplified form, took 10 minutes to complete, 15 at the most. How many of you, yes or no, have ever in the past completed one of these or helped a family member or a friend? Just unmute yourself if you would. And Haley, if you'll type into the chat, yes or no. Have you ever touched a 1040 EZ?
No.
Yeah.
Okay. Yes.
No.
No? No? A lot of no's, some yeses. Haley, a yes as well. Thank you. Okay. Now, moving right along. It's changed. Why did it change? Or was this simplified form eliminated? Well, because in theory, pardon me, the 1040 was simplified. Do you see this? The 1040 was simplified. But it really wasn't. Well, you're going, was it or wasn't? Well, in theory, okay, technically the 1040 was simplified. The back of it was eliminated, much of the back. But look at these schedules 1, 2, and 3. It's like, what? What's this? Up until the TCJA 1/1 of 18, we've had schedules A through F for many, many years. Well, A through F rolled up directly to the 1040, meaning the numbers. If you looked at Schedule A, Schedule B, C, all this, the numbers, the ending numbers, there was a spot or a line item on the 1040 that it would roll up to. When the TCJA kicked in, these little schedules, which are kind of in between, now schedules A through F roll up to schedules 1, 2, and 3. Schedules 1, 2, and 3 roll up to the 1040. So yes, technically the 1040 was simplified, but in reality, the whole process was complicated. Ask any tax preparer, I'm serious. Oh, was the 1040 really simplified with TCJA? They will laugh. Now, not to confuse anyone, but you need to put this, in my opinion, you need to put this in your notes off to the side, schedules 1, 2, and 3. In 2018, which you have right there in your cash flow modeling, you will use an 18, whether it's 18, 19, 23 year ends, whatever. But in 2018, there were schedules 1 to 6, not to confuse anyone. Then in 2019, 20, 21, consolidated to 1, 2, and 3. So even from 2018, the first year of the TCJA, to 2019, a change, significant. 6 schedules consolidated down to 1, 2, and 3, 3 schedules. Now, A, B, C, D, E, F, very little, if any, changes. What I'd like everyone to do, spend a couple of minutes on this. What is the major theme of Schedule A? We've already covered this. So off to the right, you can put it right down below, either way. What is the major theme? It doesn't have to be, these are just brief definitions or explanation. What's the major gist or major theme of Schedule B? You can be very brief. What about Schedule C? What about Schedule D, E, and F? Go ahead, spend just a couple of minutes, everyone. And we'll go through this as a class in just a couple of minutes, but take a moment. What are the major themes of each of these schedules in the 1040? Or schedules to the 1040? By the way, not only this activity, but all activities today, I beg of you, if you get stuck, don't hesitate, grab your cell phone. You can always type this in to the cell phone, absolutely. Go ahead and proceed if you would, please. Take just another moment or so. Pardon me, pardon me. Take another moment and let's go ahead and we'll summarize these. Take just another moment, complete these, if you would. And once again, if you get stuck with these or anything we covered today, you can always grab your phone. Okay, here we go. Heather, we know Schedule A is itemized deductions. What about Schedule B? What about Schedule B? Heather, you can unmute yourself. I know you had some technical difficulty there.
Yeah, sorry about
Oh,
that.
oh no, that's not, oh, now you sound great. Go ahead.
Yeah. Oh yeah, you guys are going in and out. Is it figuring out what's being taxed on interest earned?
Yes, put in your notes, just interest and dividends, interest and dividends. Excellent. Okay, Kristen, what's the major theme or gist of Schedule C?
Profit or loss, foreign business, sole proprietorship.
Good, excellent. I put in your notes, profit loss, you just said, from a sole proprietor or a single member LLC. Single member LLC. Excellent. Anar, what about Schedule D? Schedule D, what's the major theme? Anar, what's the major theme? Do you have that for Schedule D?
I am not sure.
No problem. No problem. Michelle, how about you for Schedule D?
Yeah, capital gains and losses.
Excellent. Capital gains and losses. Good. Okay. Haley, how about you? And there are 3 main activities in Schedule E. Haley, can you name just at least one of them? If you'll type into the chat while we wait on that. Kobe, can you name at least one activity of the 3 on Schedule E? At least one. Kobe, please.
And Schedule D,
Oh, Schedule E, Schedule E.
oh, and Schedule E.
Yeah, one of the 3. There's 3. Can you name at least one?
Rents received.
Excellent. Put in your notes, rental income. Good. Okay. And from Haley, profit from a sale. Yes, that's good, Haley, but that's not one of the major 3. If you'd add this to your notes, it's rents received. Okay. And number 1, number 2. So we've got rents received, number 1, number 2, royalty income, and number 3, the pass-through K1 income from a partnership LLC or an S corporation. Number one, rental income. Number two, the royalty income. And number three, the pass-through K1 pass-through income from an LLC or S Corp. Okay, all right. Now there's another individual that just responded and said income from partnership. And the last name I believe is, let's see, I want to make sure I've got this right. It's BEGUM. I don't, is it Shahida? I don't, if you can respond and open up, I don't know if you're with Chris Mark and audibly preferably, or if you can tell us, no, I've got to stay on the chat. We'll have you participate in the chat. Let's see, Heather I don't know if I'm saying it right. Is it Shahida? Are they with, okay, yep, with Chris Mark,
Yeah.
but audio is not working and her name is it her? Is it Shahida?
Yeah, she doesn't have audio.
Yeah, she doesn't have audio. Okay, so hold on. Shahida, I'm gonna write you down. Excellent. And you're with Crestmark. Hold on. Excellent. Okay, so Shahida. Okay. And she says income from partnership, right on. Excellent. That's number three. Thank you, Shahida. Okay, so we'll have her. Hold on, I need to just mark my little notes here. She's going to be on the chat so that I can keep track. Excellent. Thank you. And thank you for welcome. I'm glad you were able to join us. And by the way, while we're on this subject, anyone else from Crestmark, if you can shout out audibly or through the chat, that'd be great. Because I know you had a good sized group. And I think at the start we didn't have everyone. So if you wouldn't mind doing that. Okay. All right. Schedule E, 3 big activities. Rental income, pretty straightforward. Bob and Sue have a rental house. Royalty income. We've been banking, we've been the account officer for Bob and Sue for the last year and a half or so. Worked with Jane, worked with George, the CPA, independent CPA. But getting to know Bob and Sue, we discovered something we could not believe. 12 years ago, Bob and Sue were just starting the manufacturing firm, ABC LLC, in the suburbs, or and not the suburbs, but the area of Detroit. Okay, now, what we didn't know is prior to that, Sue wrote a #1 hit song, went into the charts. She only had the 1 hit song, but and people kind of joke about that. What do we call someone? And just this is a class shout out. What do we call someone who has only had 1 hit, if you will? 1 hit, that's all they ever did in their career. What do we call that person?
One-hit wonder.
A 1-hit wonder. Excellent. Shahida said that as well. Shahida, excellent. And whoever shouted out, a 1-hit wonder. Excellent. Now, that's derogatory. But does Sue mind it? Oh, no. Because she opens the mailbox once a month. She opens that mailbox and there is a check from anywhere from $20,000 to $30,000 a month in and month out, royalty check. Okay, I need to ask the question, Kobe, could you handle being a 1-hit wonder and getting a check every month for $20,000 or $30,000? Oh, and she's gotten it for over 15, 18 years now. Go ahead, Kobe, could you handle that?
Oh, sure can.
Good. Heather, could you handle that check? Could you handle getting one of those checks?
Absolutely.
Yes. Okay, now, rental on the property, rental house, royalty. Third activity under Schedule E, the pass-through. We're going to see this in a moment on the personal cash flow for Bob and Sue. We're going to see where the K1 income, or not income, but cash inflow comes or is inserted into the cash flow model. But I emphasize, we don't take we do not take the income tax figure from Schedule E. And we're going to see this on the K1s on the top on box 1, which is the pass-through for tax purposes. That's not the number we use. For cash flow, we look at the K1s, which we will read when we get to our business side of the equation, as I mentioned or alluded to earlier, for the S Corp and the LLC K1s, which are a little different format, each a little different from each other. That true cash flow from the K1 is what we insert into the cash flow. Now, this is the tax form, but just alluding to that eventually we're going to look in just a moment on the cash flow model. So 3 big activities: rental, royalty, and the pass-through. Schedule F. Christian, what's Schedule F? What's the major theme of Schedule F?
Profit or loss from farming.
Excellent. Profit and loss from farming. Okay, now, before we leave these forms, everybody, if you would put in your notes right below, somewhere near Schedule C. A Schedule C statistically has approximately 4 times more likely audit than a separate business like a 1065 for an LLC. Literally 4 times more likely to be audited. Why? It's because of what's called a hobby business. You see these hobby businesses every once in a while. You look at the 1040 Schedule C, you're thinking, this isn't really a business, but it's on Schedule C. And in your mind, you think, oh, they're just getting a tax write-off. Well, the IRS will probably see through it as well. If you saw through it, they'll probably see through it. Let me illustrate. Dr. Jones is a top neurosurgeon in the Detroit market. She makes at least 1.2 to 1.3 million a year. Top neurosurgeon, brain surgeon. Pardon me. She is also a photographer, meaning that's her hobby. Oh, she'll charge a few things here and there. And usually her expenses are 20, 30,000, and she may make 5,000 at most, charge a little bit here and there, but not much. It's mainly just in her mind to cover expenses, but she really doesn't cover expenses because she makes more, 4,000 or 5,000 a year and her expenses are 20 or 30. I mean, she's really into photography as a hobby. Someone says to her, Dr. Jones, why don't you write that off? File a Schedule C. Oh, could you imagine? IRS, they analyze their tax return. It even says on the tax form, well, what's their profession, whatever their title, their profession? Neurosurgeon. Oh, and then she's got the Schedule C, and she makes 1.2 to 1.4 million. Then she's got this little Schedule C for the photography business, hobby business, disallow. What about Schedule F? If you put a little note next to Schedule F, please. Farm income, approximately 2 times or double the risk of audit versus a separate 1065 or 1120S, LLC partnership or an S Corp tax form. Why? Because farmers are notorious in running a lot of personal items through their Schedule F. Okay, need to have a class shout out. How many of your banks actually bank the farmers in any way, shape, or form? Let's just do a class shout out, yes or no. And those individuals in the chat, which is Haley and Shahida, if you will just type into the chat yes or no on the farm. Do you bank the farmers? Okay, everybody else just unmute yes or no audibly. If you'll just say yes or no, we bank the farm. Maybe not you personally, but your bank does. Go ahead. No?
Yes.
Yes, we got some no's, yeses. Okay, we've got yeses, we've got a lot of no's. Haley says yes. Shahida, what about you? If you can Type in, oh, here she comes. Not come across it, so I would say no. Good. Okay, thank you. Let's move forward. Page number 5. Now, before we go into the cash flow model, let's take our first break of the morning, 5-minute break. We come back. We're going to work on the personal cash flow for Bob and Sue, our imaginary couple. Of course, they own an imaginary business, ABC LLC, imaginary CFO Jane, imaginary CPA George. We're going to go through this model in depth. Then we're going to go out to exhibit number 1 and match up the tax forms to the model. Just basically extract the items of cash flow and insert them into this model. So let's take a 5-minute break. What I recommend everyone does, keep your system up. And then if you have the audio, just mute. But when we come back, unmute yourself. Talk to you in 5 minutes. Thank you, everyone. Excellent. Excellent participation. Thank you. Welcome back, everyone. We'll take just a moment and we'll get started. So let everyone get back in. If you would come back in, that'd be great. Okay, we're going to start with Anar. Can you please give us a sound check? In other words, just unmute your phone or your line and just say, just, hey, we're there, just to make sure that I can hear and that the system's running. Just if you just give us a sound check, please, Anar. Wait just a minute. Looks like everyone's still getting back in. Pardon me. Okay, Anar, are you back with us? All right, Michelle, are you back with us?
Yep, here.
Okay, good. Thank you for doing the sound check, Michelle. Thank you. Okay, now.
I'm here too.
Oh, Anar, okay, thank you. Thank you so much. You bet. Always like to do that just to make sure that, because with Zoom and these platforms, you never know when the system's down or whatever. Cash flow, Bob and Sue, personal, business owners, not the consumer borrower traditionally, although they could be a consumer borrower or a mortgage borrower. They're your commercial borrower from the individual business owner perspective. Wages, salaries, add back in the interest and dividends. Business income, Schedule C, whether it's a sole proprietor or a single member LLC, add back the interest expense on the business. Why? Well, if you look down below, you can see under number 2, the business outlay of cash for the debt service. Pardon me, P&I, principal and interest. So we add back the interest up above because in the numbers in this cash flow model, the business debt service, of course, interest is taken out. But what people don't realize, and I put a little note at the top right, do you see of the form business income? Business income is net business income, Schedule C. It already is netted out, meaning interest expense has already been taken out. So because interest expense has been taken out of the business income and we take it out down below, we've quote unquote double dinged the cash flow. So we must add back interest up above. If we don't, we've taken out twice. One more time. It's netted out of the business income up above in that net figure. And we take it out down below under number 2. So we take it out twice in the cash flow model. We've got to add it back in once, otherwise we've taken out twice. Unfair to the cash flow, so we add it back. What about depreciation, amortization, depletion? These are traditionally or generally non-cash expenditures. Now, what type of asset do we depreciate? Vehicles, equipment, buildings. What about amortization? Amortization is like depreciation. You remember your accounting classes and so forth. Amortization is like depreciation, but it's for an intangible asset, such as goodwill or a patent or a logo, copyright. What is depletion? Depletion is like depreciation, but it's for a natural resource, timber, oil, natural gas, coal, something of that nature. Now, depletion. We add these traditionally back in. We will see an exception on the business side later today on depreciation, where we may or may not add back certain depreciation. But generally speaking, all 3 of these, depreciation, amortization, depletion, we add them back in. Now, before we move forward, essentially, this is literally the same thing as the EBITDA formula for the freestanding business, the C Corp, the S Corp, or the LLC. But it's in the Schedule C, so it's embedded within or combined within the 1040 personal tax return. But you'll notice it's earnings or net income, net loss before interest I, depreciation D, amortization A, depletion D. EBITDA formula, cash flow from the business perspective. Capital gains, capital losses. This is, of course, Schedule D. Schedule D. So interest, dividends, B, business income, C, capital gains, losses, D, rental real estate, Schedule E, royalty, Schedule E, and the pass-through, K1s. So those three are the big three, Schedule E. And then, of course, Schedule F, farm income, which we'll see in a moment. And then, of course, other income like director fees. A lot of community banks, the directors they will come to attend the board meeting once a month. They get a check for $1,000. What? For 1 hour? What? Of course, they're doing a lot of other work. They're on committees and all this, but officially it's $1,000 for the 1 hour. Wow, that's good. But once again, they're involved in the bank and there's a lot more to it. Roll all of this, and they get a 1099 at the end of the year. Roll all of this together, total income or cash inflow. Then we subtract off federal and state taxes. Now, because you are in Michigan or Illinois, Christians in Illinois, everyone else is in Michigan. You pay state tax, whether you're in Michigan or Illinois, both. But right below the word state, I put the number 9. There are 9 states that have no state income tax. Yeah, everybody pays federal, but there's 9 states no federal or no state income tax. I need everybody to name the 9. Take a moment, grab your cell phone. Some of you may know a few, like for example, let me just throw out 2 of them. Texas and Florida, those are 2 of the 9. But go ahead, everyone grab your cell phone and look that up. You can just look that up. What are the 9 states that have no state income tax? Go ahead, spend just a moment on this, please. Take just another moment. We'll go ahead and summarize the 9, list them all. Okay, here we go. I mentioned 2 of the 9, Texas and Florida. Shahida, would you type in just a couple of more if you would? Let's go ahead. We've actually got some feedback already. Oh, Shahida, you've already done it. Excellent. So we've got Texas, we've got Florida. She's added Nevada, South Dakota, Tennessee, and Alaska. 1, 2, 3, 4, 5, 6. Excellent. All right, there's 3 more. All right, let me ask Haley if you can type in. Do you have the other 3? We've got Texas, Florida, Nevada, South Dakota, Tennessee, Alaska. Haley, can you add the others? The others. Here she goes. Here she goes. Excellent. New Hampshire, Washington, and Wyoming. Excellent. So once again, Texas, Florida, Nevada, South Dakota, Tennessee, Alaska, New Hampshire, Washington State, and Wyoming. Excellent. Okay, excellent. We got them all. Now, I want to emphasize just a little trivia here. You can add these to your notes if you'd like. Off to the side. What is about one of the best places in America to live tax-wise? What city specifically? Vancouver, Washington. Not Vancouver, BC, Canada, but Vancouver, Washington. It's a pretty good sized city. It's a suburb of Portland, Oregon. It's across the river, the Columbia River, across the bridge from downtown Portland. Why would Vancouver, Washington, state of Washington, be one of the best, if not the best? Well, you live and work on the Washington side of the river, Washington state. No state income tax. But where do you shop? You get in your car, you drive 5 minutes across the bridge, you're in downtown Portland. You shop in Portland. Why? No sales tax. No sales tax. You get the best of both worlds. Now, I train regularly in Seattle, in the Seattle market. We have bankers from Vancouver, Washington, and Portland come up to our classes, to the classes there. Well, they've told me, well, and they live in Vancouver, Washington. They live and work on the Washington side. No state income tax. They shop in Oregon. No sales tax. Best of both worlds. Well, but they said, when you shop for, like appliances, for example, washer, dishwasher, clothes washer, whatever, fridge, whatever, they'll ask you, okay, well, what's your zip code or whatever, because otherwise, oh no, you're going to pay tax. Well, the bankers tell me what everyone does is they have a friend or a family member in Oregon. Oh, they just use their address or use their zip code. But they said it is literally one of the best places to live tax-wise. Now on the negative side, where's one of the worst? Just a trivia. New York City. Why? Federal tax, state tax, and their special city of New York income tax. Wow. All three. Moving right along. Total income minus federal and state tax gives us cash flow available for debt service. Minus 1, 2, 3, and 4. Personal debt service for Bob and Sue. Business, if they have business income up above. And I would put next to number 2, I would put plus farm debt service. If they have farm income up above and there's related debt that they're servicing for the farm through their personal, or not personal, but through their 1040, or not 1040 Schedule F, pardon me, then you'd put the related debt service. So by next number 2, I'd put plus farm debt service, not just business. Business is alluding to Schedule C up above. What about Schedule F? You could do the same, add it in. Rental, if they have rental real estate income up above, they have the payment on the house or the rental house, PITI, principal, interest, taxes, and insurance down below. And number 4, living allowance. Cash flow available for debt service minus the combination of 1 to 4 gives us the margin or the excess. Cash flow available for debt service divided by the combination of 1 through 4 gives us the DCR, or your bank may even call it DSCR, debt service coverage ratio. This is debt coverage ratio. That's the basic flow. Now, before we move on, look at living allowance. Starting about 4 years ago, the federal bank examiner started to say, we want the commercial lenders to include a living allowance in this personal cash flow model for Bob and Sue's of the world. Okay, Kobe, in your bank, Kobe, how do you do a living allowance? Some banks still don't, but most do. Kobe, how do you calculate it if you do?
That I'm not sure on.
No problem.
I'm not sure if we still do.
Okay, no problem. Heather, how about you? In Chrismart, do you do a living allowance, number 1, number 2? If you do, how do you calculate it?
We don't do personal loans.
Oh, okay, that answers that. Okay, let me illustrate. Most banks And there's multiple ways to do this, calculate it. But if you would add this to your notes, the living allowance, this is a very common approach nationwide with commercial underwriters. 15,000 per adult, 5,000 per child. 15,000 per adult, 5,000 per child. So if it's Bob and Sue, it'd be 15 and 15 or 30. 5 and 5, 10, combined 40,000. Simple formula. And there's multiple ones out there that I see regularly. But that one is a real common one. Some banks even keep it even simpler. Oh, in our county, it's 40,000, it's 30,000, it's 50,000, whatever, just a bulk figure for everyone. All the examiners, federal examiners, bank examiners want to see that you, the commercial underwriter, has put some sort of a living allowance in this model. Okay, let's move forward. Christian, number 2 on this, what is your minimum DCR for your bank, or DSCR maybe? Some banks says DSCR. What's your minimum standard?
I'm not sure I can disclose that.
Okay, all right. Most banks, the minimum DCR is a 1.20. Okay, all right. Shahida says 1.20. That Shahida, that is the nationwide standard of 1.20. Absolutely. Most banks in America 1.20. Absolutely. On this model. In fact, we're going to look at 3 cash flow models, the business, and then even just a little brief review of the global cash flow. Just sort of as a foreshadowing, if you will, all 3 of these models for most banks today nationwide is a 1.20. Okay. Now, how do you interpret 1.20? Pardon me. For every $1.20 of inflow, there's $1 outflow. $1.20 in, $1 out. $1.20 in, $1 out. Absolutely. Absolutely. Moving right along. Now, one other thought, we will turn to Exhibit 1. Look at adjustments down below. Now, this is real. You may have a situation where you know of something that could alter to the positive or the negative. And let's say it's on the positive side to illustrate, where you're going to legitimately adjust your cash flow model. For example, let's say your DCR is a 1.20 standard. That's your bank standard. But let's say when you do the actual deal, it comes in at a 1.18. Ooh, let's say you have a real stickler for a credit administrator, like I had when I was on your side of the table, okay? And we're just on opposite sides of the table, opposite sides of the desk, because I work with my CFO clients, with their lenders, and of course I trained the bankers and all this. Well, this gentleman, his name was Paul. His name's Paul. Oh, nice guy, but oh, he could be a stickler. Oh, he would say to you, if it's not at least a 1.20, don't even bother showing me the deal. I'm not going to sign off on the deal. Oh, okay. Now, DCR, DSCR. So what if you did have a 1.18 and you're thinking, oh, I'm so close, but Paul's a stickler. He will not approve this deal. You look back through the numbers and you think, well, these are the numbers. The numbers are the numbers. I can't fudge them. But look up above on the top left-hand side of the page. Do you see wages and salaries? I put a little asterisk there, a little note there. You asked Sue, the CFO, did Bob and Sue have 401ks? Oh, yeah, they both do. Do they fund them 100? Do they fund them? Absolutely. That's discretionary. Those are pre-tax dollars. If you'd add this to your notes for 2021 right now, the max on the 401k It's not 6,000 plus 1,000 like on the IRA. It's 19,500 plus $6,500 catch-up provision. Whoa, for a total of 26,000 per person. Bob has his 401k, Sue has hers. You take 26,000 times 2, that's $52,000 add back. Put a little footnote, little asterisk, little footnote down below. Discretionary. They matched up their 401ks. You add 52,000 up above with wages, salaries, funnels all the way down through. Chances are that DCR is going to be, 1.22, 1.23 at least, something like that. Absolutely. Questions? Anar, questions on that? Does that make sense what I just said?
Yes, totally. I was about to say we can do some add backs.
Oh yeah. And there could be some others. Anar, you could find some others. Christian, you can find some others. Haley, you can find some others in here. Absolutely legitimate. Now, not like my old boss at Bank of America. Oh no, because his cash flow modeling, he would grab numbers out of thin air and plug them in, and it's like, well, where'd you get this number? Now you may say, well, how did I know? Well, my boss managed, he managed his own loan portfolio like we all did. His was smaller because he had administrative duties as our team leader. The reason why I know for a fact what he used to do, pardon me, is he would come in my office and show me his cash flow models, just handwritten, scratched, not typed into the loan write-up or whatever, and just kind of his quick and dirty. And he'd have, here's the tax returns. Hey, would you look at my numbers? Yeah. Part of it was to soothe his conscience. Why? Because he knew it was bogus. He knew his numbers were bogus. Absolutely. One other thought, we move on. Do you see wages, salaries? I mentioned 19,500 plus 6,500, a total of 26,000 per person. Now we'll see this in Exhibit 3. The self-employed may even be able to go higher. The self-employed can even go higher. Meaning they can go up to like 58,500 in this year, 21, plus another 6,500. So it's like 28,000 or 58,000. So it's like $64,500. But that's for the self-employed, and there's some pretty heavy calculations you got to go through to be able to determine, can they go beyond the 26. And this is quote unquote assuming Bob and Sue are 50 and above age-wise. Let's say they're both in their mid 50s. Well, once again, the catch-up provision for the 401k is 6,500. The 19.5 plus the 65 or 26,000. That's for everybody in America. Business owner, W-2 employees like yourselves, anyone. These other provisions we'll cover later. We'll look in Exhibit 3. They could even go much higher. But without any argument, 26,000 apiece, because they're 50 and above, and they do max out their 401ks per your discussion with Jane, the CFO. Absolutely. Let's move forward. Page number 6. Now, page number 6, we're going to shift into Exhibit number 1. Now, but before we do so, everyone, if you would please turn back one page to page 5 in the main PowerPoint. And then if you will please put the main PowerPoint, your hard copy, just to the left of you, right there in front of you, but I mean to the left of you. And then if you would take Exhibit 1 and put Exhibit 1, the hard copy, in front of you. So on your desk or table, you have Exhibit 1 in front of you. You'll see Exhibit 1. I'm gonna share the screen in just a moment. In front of you, you've got Exhibit 1 to the left. You've got page number 5. So as we go through the tax forms, you'll just be able to toggle back and forth. And I'll say, oh, look to your left, look in the cash flow, and look to the right or right in front of you there. This is how we're going to interpret and extract the cash out of the return and put it into page number 5. So give me just a moment, and I'm going to share exhibit number 1. Okay, here we go. Okay, you should see this right there on your screen. Michelle, can you see exhibit 1 on your screen?
Yes, I can.
Excellent, thank you. So you've got that right on your screen, and then right in front of you, you've got the hard copy exhibit 1, and to the left, page number 5, the main PowerPoint, the cash flow model. Let's go ahead and proceed forward through this. Now we have the blank forms for 2020. 2021s are not created. They won't be created till the spring of 22. And we've got the examples we're going to see later. In just a moment, we've got 19s that are filled in because the tax season just finished. Next couple of months, I'll have 20 blank forms still, same blank forms, and then 20 with some numbers in them. But we've got the most updated you typically see. And between 19 and 20, the forms haven't really changed at all. It's interesting. Some years from year to year, no change. Other years, of course, depending on what Congress does and the change of the tax code, it can be radical, like the TCJA, most radical in over 30 years. Oh, easy. Changes throughout those 30 years, of course, little changes here and there, but not to this level. Here we go, 2020, the 1040. If you please highlight line number 1, wages, salaries, tips. Okay, now if you look to your left, right there on page 5, wages and salaries. There it is. We're just going to follow it right down in the format. If you please circle the word tips and just put a little note, please. You can only count tip income if the tip income shows up in the W-2. If it doesn't show up, you cannot count it. Tip income is earned typically from workers in restaurants, bars, and casinos. Let me use an example. Typical casino worker in Las Vegas. Their base salary, and this is a kind of a lower, if you will, employee, not to speak out of school, but it's they're kind of lower in the rung, if you will, and the pay scale and the rung of the casino. Their base salary is $30,000. Okay. Now they get a W-2 for 60. What? For 60,000. What? They're not one of those executives, making $200,000, $300,000, $400,000 a year in the casino. There's a lot. The way the casino industry works is there's just a few execs and a lot of worker bees. And this worker, he gets $30,000 a year base, but his W-2 60. What? Where did the extra 30 come from? Tip income. Every 4, 5, or 6 years, the IRS will negotiate with the casino. This happens in Michigan with the casinos in Michigan and in Illinois. Absolutely. The IRS comes in, they meet with the casino executives, whatever. We want your list of all your job titles. Okay, job titles, highest to lowest, lowest to highest, doesn't matter. And based on their job title, based on their position within the casino, it is quote unquote assumed that they're going to make for this position, even though their base income is $30,000, nothing to write home about. But their tips are quote unquote assumed to be another 30. And in reality, their tip income is not 30. Their tip income is 60,000. What? Their real income is 90. So this employee that's just, the quote unquote, oh, you're just the worker bee. Oh no. Sometimes they're making much more money than a neighbor of theirs that, is just professional or whoever. I'm serious. 30,000 base. Another 30 that they get taxed, pre-negotiated. That's their assumed level of tips. But in reality, they have another 30 beyond that. Well, what's that? Additional tips. never taxed. Absolutely. We have casino workers in Vegas. Their base salary, what's your base salary? 30,000. Oh, you think, oh, okay, that's not making that much in America today. I mean, I remember when 30,000 was a lot, but not today. In reality, they're not making 60. They're not making 90. They're making 130,000. They're making, or if they're getting taxed on 60, they're making 160,000. Some places they're making an extra 100,000 in tip income, never taxed. True. There's a gentleman I know, Caesar's Palace. He's been there for over 50 years parking cars, literally. I talk to him every time I'm there in meetings. This is pre-COVID. And I'd say, well, if you don't mind me asking, and I've kind of gotten to know him. Well, can you tell me, have you ever gotten some sizable tips? Like, and I just threw out 5,000. He looked at me and he goes, oh, 5,000? I've gotten more $5,000 tips over the years. I can't even count them all. So then I naturally said, well, what's the big, I just kind of threw it out there and thought, well, he may tell me, he may not. But I've gotten to know him. It's like a friend. I said, what's the biggest tip you ever got? Okay. Shahida, if you can type into the chat, Haley in the chat, please, if you type in, what's the biggest tip this gentleman has ever received? Ever received. And this is from, him parking cars. He's a valet. Caesar's Palace. Just if you would type that in, just take a step, just a guess, just type in, what do you think the biggest tip he ever received? Shahida says 10,000. Haley says 100,000. 50,000 in the form of a casino chip. He says some guy stumbled out of the casino, just won a big jackpot. He was half drunk, flipped him a chip, $50,000. Was it ever reported? No. Now this is pre-BSA. Otherwise, that would be reported. Bank Secrecy Act. But 50,000 in his pocket, absolutely. But we can only legitimately count what's on that W-2. Let's go to number 2A and 2B. If you'd highlight 2A and 2B. Thank you, by the way, Shahida and Haley, thank you for those responses. 2A, tax exempt interest. Now, if you look over to the left, we're just going from wages, salaries over to the interest, income, dividends, so forth. Tax exempt is from a municipal bond, like the city of Lansing will issue a bond, long-term debt instrument. Well, the interest on that bond for federal purposes, and let's say Bob and Sue buy the bond as an investment. Well, for federal purposes, the interest is usually not taxed, even sometimes state. What about 2B? What would be an example of 2B? Interest on a bank CD, on a bank CD. Okay. This brings us to the first of our two major models on the personal return. In the bottom of this blank space, if you put in your notes, model number 1, please. And right below model 1, on the left side, CPA tax, and over to the right, banker cash flow. CPA tax, banker cash flow. What does this mean? Well, CPA tax. George, remember George is Bob and Sue's independent CPA, okay? He will fixate on tax all the way. You, the banker cash flow specialist, you fixate on cash flow. Let's go back up to 2A. There's a dollar amount in 2A. Municipal bond interest from a muni bond or municipal bond. George says, well, I'm not going to count that. You say, why not? Oh, Bob and Sue aren't taxed on it. That's the CPA tax mentality. What about the banker cash flow mentality, your world? You say to George, but they receive the cash. They physically get the cash. We're going to count it for cash flow purposes, which I agree with. What about part B? George says, oh, I'm going to count that. the interest on the bank CD. Oh, I'm going to count that. Well, why? Well, because they're taxed on it. What about you, the banker cash flow special? I'm going to count it because they receive it, not because they're getting taxed on it, but because they receive it. So sometimes we agree, sometimes we don't with the CPAs. Let's go down to number 5A and 5B. 5A and 5B, pension. Okay. Sometimes you'll see on 5A, 30,000, just to use a number. 5B, 25,000. For whatever reason, they're not taxed on the full amount. Okay. Legitimately. What number for cash flow purposes would George use? CPA tax mentality or thought? What about you, the banker cash flow specialist? Well, George is going to say, I'm only going to count 5B, what they're taxed on, the 25,000. But what would you say? Oh no, George, it's 5A, it's 30,000. Why? He'll look at you like, why? Because under 5A, that's how much they physically receive in the form of cash. Absolutely. Let's move forward. Let's turn forward. You can see on the bottom of that first part of that first page of the 1040, you can see some of the steps we've covered. Adjusted gross income, standard under line 11, line 12, standard deduction or itemized. Then if you turn forward to the next page or the back or the second part of the 1040, you can see the refund about halfway down and the amount owed. Moving right along. Now for schedules 1, 2, and 3. This is a page, this page is straight off the IRS website. And if you take just a moment and read the description for these schedules 1, 2, and 3, take just a moment if you would, please. Take just another moment and we'll move forward into the forms themselves. Okay, let's move forward. Here we go. Schedule 1. I'd highlight Schedule 1 in the title. Okay, let's go through this. Part 1, line 1, taxable refunds. Because you're in Michigan and or Illinois, you may see on a client a tax refund state. But do you add it back in to your cash flow model? Kobe, do you add the taxable refund back into your cash flow? Do you know in your world, do you usually add that back in?
Yes.
Okay. All right. Heather, how about you? Heather, I know, do you look at the business or the personal tax returns or no? Heather?
We don't.
So let me understand, your commercial lenders, is that correct?
Yeah.
But then you don't have, are you working with mainly publicly traded corporations where you don't, have guarantors and the individuals like Bob and Sue?
We do get some personal tax returns. I have not run across very many, so I don't know if anyone else from Crossmark has, but I haven't. I know we do get some though.
Okay,
We don't make any personal loans though.
no, we're not talking personal. This is business. This is
Okay.
commercial.
Yeah.
This is Bob and Sue, business owners as guarantors, pardon me, of a line of credit to their business, equipment loan to the business, or commercial real estate loan. So what type of credits? I'm just trying to figure out what type of credits do you work on? What type of loans do you work on?
We do like solar loans. We do factoring, asset-based loans.
Okay, gotcha. But even in factoring or in ABL,
Mhm.
you would still take a guarantee, wouldn't you? Or
Yes, we
not?
do. Yeah.
Okay, but your team doesn't work on the personal side, right?
Can I say something?
Yes, uh-huh,
Okay, so I work on these new deals and we make kind of prequels and
yes,
when we run through global cash flow, we do check guarantors' personal income taxes.
okay,
That point, we do not add back the tax refunds. We don't.
gotcha, gotcha. Is this a NAR that's talking right now?
Yes.
Okay, gotcha, okay, good, thank you,
So
it just
even
helps me.
though it's business loans, commercial loans, business acquisitions or refinancing, yes, we do check guarantors' personal income taxes. And
Yes,
yeah, we don't add tax
gotcha,
refunds.
good. Approximately, thank you for that clarification. Thank you, Heather, as well. On line one, taxable refund, state tax refund, approximately 70% of all bank lenders do not add back state tax refund. 70% do not, NO. About 30% do nationwide. That's my unofficial poll. The reason why the vast majority don't is because it's from the previous year. It may not recur in the future the same amount and so forth. Just a thought. Alimony received, we said that. We said, well, wait, that went away. Well, but remember, some agreements, if you will, spousal agreements, spousal support, we talked about separate maintenance agreement. Some of those will be in place for 10, 20, 50, 10, 15, 20, 25 years even. So they're grandfathered in, so they would have that benefit, either received and or deducted down below under line 18A. Back up to number 3, business income. We'll see Schedule C in a moment. I'd highlight that. Line number 5, the 3 big, rental, royalty, and the pass-through, K1, for the partnership, LLC, and or S Corp. And then line number 6, farm income. I'd highlight that, Schedule F. Then under other income, we use director fees. I'd put director fees, but you could also have what is called net operating loss, or NOLs. Christian, do you see any NOLs ever? Have you ever seen that in your career? Net operating losses. Christian, have you ever seen that? Michelle, have you ever seen an NOL, a net operating loss?
Yeah, you see it.
Okay, so you see it periodically.
Yeah.
And Michelle, in your world, now you're with Crestmark, correct?
Yes, that's correct.
Okay, but you're in the SBA, so you're dealing with the smaller business owners and so forth, where you take their guarantee and you're looking at their personal. Well,
Yeah.
what is an NOL? Net operating loss. An NOL is the net operating loss is, let's say that ABC LLC, the operating business, let's say it has a $1 million loss. Okay, so it's got $1 million loss. And George, the CPA, says, Bob, Sue, and Jane, the CFO, why don't we take that loss and carry it forward $100,000 a year? Okay, for $1 million. So it's $1 million divided by 10, or 100,000 a year, which will essentially wipe out most any tax they're going to owe for the whole 10 years. The rules relative to NOL has changed with COVID, and we'll come back to this extensively later. But at this point, I'd like to have you, and I'll cover those later to make, because there'll be a lot more sense to it. But for cash flow purposes right now, if you put right next to NOL, net operating loss, on line number 8, other income, which is a loss actually, if you put a little note, most commercial lenders do not count the NOL as a positive or a negative for cash flow purposes. It really becomes kind of NA, not applicable, if that makes sense, NA. Now, why? What does that really mean? Well, it's the NOL because ABC LLC suffered the $1 million loss, like let's say 5 years ago. And Georgia's CPA is going to spread it out over 10 years. And now they're about halfway through. And it shows up on their tax return for 2020. You know, a negative 100,000. $1 million divided by 10 years is 100, of course, 100 each year. But for tax purposes, it knocks down the tax burden, of course, huge each year. But that's on the tax side. On the cash flow, it's not a negative or a positive. Why? Because it was a negative $1 million, but that's 5 years ago. We care less what happened 5 years ago for cash flow purposes. Any questions on that? Shahida, any questions on that? Haley, any questions on the NOL? We'll come back to the tax rules because with COVID, it's actually become very flexible. That's on the tax side. But cash flow, I wanted to cover that. Any questions on NOL? No questions, Shahida says. Excellent. Haley, any questions as well? If you type into the chat, please. Nope, no questions either. Thank you. Now let's move forward. Let's go down to part number 2. Highlight line number 10. We talked about educator expense. If you would please. Highlight line 18. We talked about alimony. Highlight line number 19, IRA deduction. Okay, we talked about that as well. Now let's move forward. Schedule 2, if you'll highlight Schedule 2, including additional taxes, the most common line item you see on this is line number 4 under part 2. Line number 4, self-employment tax. I'd add that, just highlight that, please. Now move forward, if you would. Schedule 3. Schedule 3, if you'd highlight Schedule 3, and I'd highlight, do you see part 2? Credit for child and dependent care expenses. Wow. Wow. Share credit for the child and dependent care. Now, during COVID, this really expanded. A lot of people, their kids, you know, all of a sudden their kids are at home, they're at home, and their kids, and then all of a sudden, maybe they have to go to the office, but their kids are still in school online, remote, if you will, not ground-based. So that went through the ceiling. We're going to talk about later in Exhibit 3, the child tax credit, the actual child tax credit, which has expanded dramatically. Before the TCJA was $1,000 per child, pardon me, under 17 years of age. TCJA doubled it to $2,000. The ARP, American Rescue Plan, which we will see, just signed into law March 11th of 21, now has moved the child tax credit from $2,000 if the child is under 6 years of age, so 0 to 6 or newborn to 6, $3,600 per child per year. And between age 6 and 17, $3,000. And it was in the paper just a couple days ago. They may be sending out, who's they? The federal government, sending out a live check or an automatic deposit to your checking account if you have a minor child for your tax credit. You won't wait till the end of the year. You'll get cash this year, possibly. Kind of interesting. Just a thought. Let's move forward. Now, if you'll turn with me to Schedule A. Schedule A, if you'll highlight Schedule A. Now, we usually don't look at Schedule A for our cash flow modeling. If you look to your left on page 5 there's really nothing that ties in really, per se. But let me have you to highlight 8A, that's the mortgage interest. 5B, the real estate tax on the primary residence. So 8A, 5B, and line number 11, charitable donations. Moving right along. Now Schedule B, interest and dividends. Okay. Kobe, do you see many Schedule Bs? Do you see many Schedule Bs?
Yes, I do.
Okay, you do?
I don't really-
Okay.
Yes, I
Okay.
don't still use, we don't use them really.
Okay, but you do see some. Christian, in your world, I know you may not work on the personal side, but have you ever seen Schedule Bs, maybe in another area you've worked in the bank? Christian, just curious, do you see many Schedule Bs ever? I don't know if Christian's with us, it should be. If you can unmute and just let us know or through the chat. Heather, how about you? Do you see Schedule Bs ever? But you don't work on the personal side, right?
No, I have not worked on any of these yet.
Okay, gotcha. Anara, how about you? Do you see Schedule Bs in your area at the bank at Crestmark?
No, so we don't see Schedule B too much.
Gotcha. Okay, Michelle, you do see Schedule B, correct? Because you're in the SBA area.
Yeah, we definitely see them. It depends if
Okay.
there's material information on
Okay.
there or not.
Good, excellent. And Shahida just typed into the chat, she sees them. Good. All right, now, there could be 3 forms of interest on Schedule B. Underneath, and you see the blank spot where the lines are, all the lines? If you'd please put a 1, and then leave a couple lines, a 2, leave a couple lines, and a number 3. Okay, 1, 2, and 3. All right. Now, number 1, if you put bank interest, this is the most common, bank interest. You know, from a bank CD or savings account. Number 2, note receivable, a note receivable. Sue receives a phone call. Her grandma passes away. Sue inherits the house. The house is in Traverse City. Bob and Sue said, well, what are we going to do? We got a rental house. And they, remember, they live right outside of Detroit, and you know, they've got their firm, ABC LLC. Well, they say, well, we've got a rental house here in town, you know, where they live. Do we want a rental house way up there? Nah, let's just sell it. So they sell it. In this hot, strong residential market, they sell it literally in within 2 or 3 days max, if not 2 or 3 hours. But the new owner says, my credit's shot. I went through a divorce a few years ago. Would you carry the paper? I'll give you, and it's, let's say, just to keep it simple, the house is, you know, nothing to write home about. It's a nice home, but it's 300,000 or 200,000, whatever. The buyer gives them 50,000, gives Sue 50,000 cash. She carries the paper. There's a note receivable. Interest, including interest. Scenario number 3. If you'd add this to your notes, please, on Schedule B there. Pass through. You'll see the words pass through or the name of an LLC, pass through. And of course, the dollar amounts are over to the right in the column. Okay, these are the 3 forms of interest. Before we dissect them deeper, if you would please add this to your notes at the top of this page. Model number 2. Remember, I mentioned we'd have 2 major models in this section. Model 2, part A, B, and C. A, I'd add this at the very top of this page. Pardon me. A, the word recurring. I put in your notes, please, the word recurring. B, significant dollar amount. Significant dollar amount. And C, verify, verify. Okay, it's a 3-step model. Part A, you need to ask yourself on all of these. We'll start with even the bank CD, the bank interest. Is it recurring? You have 3 years of tax returns in front of you, 18, 19, and 20. Oh, meets the first hurdle. It's recurring. It happens every year. Part B. Part B, is it a significant dollar amount? If it's $50 each year, now throw it out. If it's $5,000, oh, add it to your cash flow. Number 3, or part C, of this second model. Can you verify it with the bank statement? Or maybe the bank account is in our bank. We could verify it. Absolutely. Let's go to number 2. Sue carries the paper. She becomes like the bank. They put this house on a 15-year amortization. To keep the numbers simple, let's say she receives a payment of $1,000 a month, principal and interest. Who handles the taxes and insurance? The new owner. He pays it himself. There is no impound. So it's $1,000 a month, it's $12,000 a year. Let's say of the $12,000, let's say it's 3 years into the 15 years. And let's say of the $12,000 a year, $9,000 is interest, just to keep the numbers simple. You see $9,000 over the right on the dollar column. You go back to your still 2A, B, and C up above. Is it recurring? Well, yeah, they're 3 years into a 15-year note. Number 2, is it a significant amount? Yes. Letter C, can you verify? Absolutely. The $1,000 a month goes into a special checking account that Bob and Sue set up, or deposit account, maybe a money market account that they set up to capture these payments at your bank. Absolutely, you can verify, or a bank statement, brokerage statement, whatever. Instead of showing the $9,000 for cash flow, you could even justify $12,000. Why? How could you justify 12? Well, think of it this way. Pardon me. The reason why you could justify 12,000 is because Sue physically receives $1,000 a month, not just the interest portion. And you say, well, wait a minute, the principal eventually will erode. Well, but they're only into the 3rd year. There's still 12 more years to go. So you could justify 12,000 instead of the 9,000. Just a thought. Scenario number 3, the pass-through or the K1. Because Bob and Sue have ownership in an LLC through their K1, they have to show interest. They receive interest from the K1 or from the LLC. But they have to pick up that dollar amount as on this form, Schedule B, under the 3rd option or 3rd area. They have to pick up the dollar amount. But do we count it in cash flow? Well, let's go back to 2A, B, and C up above. Is it recurring? Oh, it can be. Is it significant? It can be. Can you verify it? Yes, but this is kind of a weird quirk to this. I'd put under number 3, pass through. They only are picking up the dollar amount to pay the tax, but they physically do not receive the interest. So this is one of those situations where, going back to model number 1, George the CPA says, oh, I'm going to count it. Why? Oh, because they're taxed on it. You say, oh, no, we're not going to count it. Because why? They physically never receive the cash. They never receive the cash. And you will see this periodically on Schedule B in our 3rd example, called pass-through and or the name of an LLC. The LLC that they are showing the interest income through. Haley, any questions on these 3? We're going deep on this. This is pretty deep, but you need to know it, in my opinion, to really understand. If you're looking at page 5 to the left, boy, how do you handle all these? Haley, any questions on this? Any questions? No questions. Good. Thank you. Moving right along. Let's go to Schedule C. Turn to Schedule C. We'll stop right there and we'll take our 2nd break of the morning. Let's take a 5-minute break. Once again, I keep the system up and then just mute yourself and unmute yourself when we come back. Thank you, everyone. Talk to you in 5 minutes. Welcome back, everyone. We'll take just a moment and we'll get started. Thank you. Okay, Kobe, can you give us our sound check, please? You're back if you can.
I'm-
Okay,
I'm
great.
back.
Thank you, Kobe. I appreciate that. Excellent. Okay, now Schedule C. If you grab your highlighter, your pen, I would go ahead and highlight these. And then, of course, you could put the code numbers at the bottom or off to the side. Well, the formula, of course, to read to read the Schedule C is for the sole proprietor or single member LLC is line number 31, profit or loss, add back line number 16, A and B, interest, add back line number 13, depreciation. And then you would look for the amortization, which is on page number 2 of the Schedule C under Part V or Part 5 down below. So the second page at the bottom, I would please add this to your notes, amortization question mark under Part V or Part 5, other expenses. And then going back to the front of the Schedule C, the last step is line number 12, depletion. So once again, line number 31, net income, net loss. Line number 16, interest, A and B, interest. Line number 13, depreciation. Go to the second page under Part V down below, Part V or 5, amortization. And then lastly, back on the front page, line number 12, depletion. Now, if you look with me to the left right there on page 5, you'll see we just followed that exact same format of the cash flow of the sole proprietor or single member LLC, starting with the business income and the add backs as well. Moving right along, turn forward now to Schedule D. Schedule D, I'd highlight each one of these. There's Part 1, Part 2. Now you'll notice over to the left part, you can see it, capital gains, capital losses right there on page 5. Now here in front of you and on your screen, we've got short-term and long-term. Short-term is less than a year, long-term is a year or more than a year, I should say. Short-term is a year or less, long-term over a year. Now let's read the cash flow. First up, what type of a situation would this be? Bob and Sue buy an individual stock. Okay. Under Part 1, if you'd please, underneath part, you can see column E or cost, that little blank spot or box. If you'd put $5,000 in that blank spot or box, they buy the stock for $5,000 in 2020, the same tax/cash flow year we're analyzing. To the left under the proceeds, that little box, I would put $20,000, $20,000. To the far right, under H, gain or loss, you'd put 15,000. Okay. So they bought the stock for 5, they sold it for 20, and now they've got 15,000. Okay. Okay, once again, in Part 1, the cost of the stock is 5,000. This is under column E. So I put 5,000 in that the first blank box. But they sell it, the proceeds to the left under box D, they sell it for 20,000. Well, what's the gain or loss? Well, it's a gain of 15,000. To the far right under column H, I put $15,000. Okay. So you got 15. All right. Now, before we move forward, what would George, the CPA, say? CPA George, what would you, the banker cash flow specialist say? Well, George is going to say, well, they're going to get taxed on the $15,000 gain, 15. What would you say from a cash flow perspective? The banker, 15,000. It cost them 5, they got 20 all within the same year. It's 15,000. Okay, you're in this situation, you're in agreement with George. George is in agreement with you. Go down to line number 6 or box 6 on the far right. Go down to 6 if you would. If you'd please put $20,000. And then line 7 or box 7 is, of course, a negative 5,000. Now wait, what's this negative 20? Look over to the left there on line 6. This is a short-term capital loss carryover. Bob and Sue had a loss a few years back on some other sale of stock or whatever it was. And they didn't utilize the loss. They were able to just kind of hold it in reserve and then bring it forward. George brought it forward this year. Well, why? Well, on a practical basis. He says, Bob, Sue, even Janie's, and Jane's aware of this. Your gain is 15,000. If we don't do something, you're going to get taxed on the whole 15. But I remembered, and Bob even goes, oh yeah, and Sue goes, oh yeah, that's right. You had 20,000 loss from a couple of years ago, never used. We can just bring it forward, put it into, insert it in lines or box number 6 there, 20,000. Line number 7 now mathematically is a negative 5. Oh, that's huge tax benefit. Now, what would George say this activity is, the CPA? Now that he's done this little carry this loss forward. What about you, the banker cash flow specialist? Okay. George, what would he say? Oh, it's a negative 5. The CPA would. Oh, no, we would go negative 5. Oh, it's a negative 5. Why? Because he fixates on tax. Line 7 is a negative 5,000. What would you say? It's still 15. It's still, whoa. George is going to go, what? Argue with you. Why still a positive? From a cash flow standpoint, they received 15,000. Well, what about the 20? George, that took place 2 or 3 years ago. We don't care. That was before our cash flow model. Oh, okay. Totally different thought, totally different emphasis. We, of course, cash flow. He, tax. Let's move to long term. Long term. Underneath Part E, the cost 5,000. Bob and Sue bought the stock for 5,000. What's the proceeds? 20. Over to the left, 20. To the far right, under the gain or loss Part H or column H, 15,000. 15,000. Okay. We say to him, we're working with Jane or whatever, and we say, well, she says, well, that's 15. Or you're working with George, the independent CPA, or you're working on your own internally within the bank. You say to yourself, well, it cost them 5. They've got 20. The gain or loss is 15. It's 15. George is going to say it's 15. This activity is 15. But what are you going to say? Let me give you the hint. They bought the stock 7 years ago. We say in our own minds, we don't care what happened 7 years ago. We care what happens this year. What is the activity from our perspective, banker cash flow? It is $20,000. Why not 15? No, 15 for tax. But how much did they physically receive this year? 20. What about the 5 they dished out originally? 7 years ago. We care less what happened 7 years ago. We care what happens this year. Any questions, Heather? Any questions on Schedule D, Part 1 and 2? Any questions?
No.
Okay. Now, Heather, and for several of you, or a few of you, I should say, at Crestmark, you may say, well, I don't touch many personal tax firms. I touch mainly, on the business side, da, 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 da. Well, but you never know. 6 months from now, you could be in a different department in Crestmark. And all of a sudden you're asked to do, to work on the personal cash flow modeling for the bar, with not the borrower, but for the business owners, the principals. So once again, following today's session, I encourage you strongly, keep the material in a binder. Keep the material in a binder, if you would, because you can always reference back. Moving right along. Schedule E, rental. If you'll flip forward a couple pages, Schedule E, rental. Now, rental, the formula. This is on the rental house that Bob and Sue own in the Detroit area, not the home they sold up in Traverse City. Okay, here's the formula. Line number 3, rents received, minus line number 20, total expenses. Add back line number 15, depreciation expense. Add back line number 12, mortgage interest. Line number 3, rents received, pardon me, minus line number 20, total expenses. Add back 18, depreciation. Add back 12, mortgage interest. And if you look to your left on page number 5, the cash flow model, that what we just calculated is the inflow up above, rental real estate. Versus down below under number line 3 are the payments, of course, PITI on the house or the rental property. So this just, of course, the inflow up above, the net inflow, if you will. Now moving forward, our last of the personal schedules, if you will. Now, once again, the K1s will wait till we look at the business tax forms after our lunch break. Okay, now, if you'd highlight Schedule F, including profit or loss from farming. Okay, now, if you look with me, okay, the formula is line number 34. You can, I would highlight it on the form, and then with your pen, just put the little code down below, 34 plus whatever, and so forth. You can just then easily reference back. Line number 34, net income, net loss. Add back line number 21, A and B, interest. And line number 14, depreciation. Line number 34, profit or loss, net income, net loss. Add back 21, A and B, interest. Add back 14, depreciation. And then, kind of in the middle of the page, 32A, that blank space, I put amortization question mark. Amortization question mark. And then 32B, depletion question mark. Depletion question mark, to see if those are there. If they're not there, or if these some are 0, they're just blank. Absolutely. That's the formula. And then, of course, if you have 32A and B, you'd add those back. Or 32A only or 32B only, you'd add it back in. Amortization and or depletion. Same exact format, really, if you think about it, as the Schedule C. This, of course, Schedule F for the farm income. Very similar. Let's move forward. Now, in the next couple of minutes, before we take our tax break, we're just going to look at a few little tidbits on the completed forms, and then we'll turn back to the main PowerPoint, to the business side, and be ready for our afternoon portion of our presentation or webinar today. Turn forward. Turn forward. We have 3 examples, or 3 1040s to look at. Let's look at the first one. Do you see the 1040? Just turn forward a couple pages, should be right there. 2019. Look under 4C. I'd highlight that. Now, this shows the pension, $1,284,000 and change. Well, wait a minute. It's 0 to the far right text. Well, the key is you can see the little word rollover. All this client, the CFO client of mine did was what? Rolled over 1.2 million plus in his retirement plans from one vendor to the other. But it's not taxable because it's a direct rollover. And so, wait a minute, from a tax standpoint, what would George say? Oh, I'm not going to count it, which I agree. What about you from your perspective, from a cash flow perspective? Oh, I wouldn't count it. No, you say don't count it. I agree. Why? Well, it's just a rollover. It's not cash, if you will, or recurring cash. Now, hopefully in the future, it will generate recurring cash in the form of a retirement check. Just a thought. Let's move forward. Schedule 1. Just turn forward a couple of pages, Schedule 1. You'll notice, look at line 5. There's the rental, royalty, the pass-through, so forth. Look at Schedule 2. Turn to Schedule 2 if you would. And I'd highlight line number 4, self-employment tax we talked about a moment ago. And then number 3, I'd highlight Schedule 3. Pardon me, do you see on line number 8, 2019, because this is the 2019 tax return, estimated payments. I put next to the 14,000 over the right. The 14, this is the accumulation or combine of the 4 quarters that we talked about, the 4 quarterly payments. April 15th, June 15th, September 15th, and January 15th in the next year for the previous 4th quarter. That's the 14,000 that combined of the 4 we talked about earlier. Capital gains, some old capital gains. Let's turn forward. Hold your eyes about 4 or 5 pages. 4 pages. Look at 89.95. This is called the QBI. Whoa, what's this? Qualified business income. This is new per the Tax Cuts and Jobs Act, TCJA. 20% pass-through tax-free. But this is reserved for small business, LLC, S Corp, sole proprietor, partnership, so forth. QBI. We'll see this in Exhibit 3 later. Let's turn forward another couple of pages. 3 pages more, we'll see the second 1040 completed. Okay. Look at line number 9. Do you see the standard deduction versus itemized? Well, in this situation, itemized was higher than 24,400. This year was 24,400 for married filing jointly. So you take the higher of the two, as I mentioned earlier. Turn forward a couple of pages, look at Schedule 1. Business income, line number 3. Schedule C, pardon me, and then of course, turn forward, Schedule A. Now the big 3, I mentioned this earlier, if you'd highlight 8A, mortgage interest on the primary residence, 5B on the real estate taxes for the primary residence, and then lastly, line number 11 down below. And highlight line 11. Look at the charitable donation, 29,386. Oh, this is what put them over to where they're itemizing instead of the large, relatively large standard deduction. Once again, you take the higher of the two. Now, the next year, they probably used, meaning this year, 2020, maybe this tax year that just ended. If they didn't have this big of a charitable contribution, this may have been like a one-time deal for whatever reason. What did they do? They do the standard deduction, the higher of the two. Moving forward, we've talked about Schedule B. Schedule C. Look at the cash flow. We would take line number 31 and highlight that. 13,712. Add back line number 16, A and B. It's blank. Add back line number 13, depreciation, blank. Add back line if it exists, turn to the next page under part V. Is there any amortization? None. So there's nothing to add back. And then lastly, add back line number 12, depletion, which is blank as well. So the true cash flow of this business, this sole proprietor or single member LLC, 13,712. Happens to be the same as the profitability. There's really no add backs. I mean, we looked at them all, but there's no add backs in this example. Moving forward, QBI as well, QBI, and our last 1040. Now, if you look at this last 1040, I need, this is just, I'm gonna open this to the entire class. Do you see anything unique about this? The hint is in the printing. Do you see anything unique in the printing? Anyone? Okay. Let me ask a few of you actually. Christian, are you there? Do you see anything unique? Kristen, if you can unmute, do you see anything unique about this third 1040? Or do you see anything unique about it? Okay. Don't know if Christian can hear me. Christian, if you can't hear, if you don't mind, if you could possibly just, you can even type into the chat. Okay. Anar, do you see anything unique about this 1040? Something to do with the printing. That's the hint. Okay.
Qualified dividends.
No. Look at the size. Look at the size of the print. Do you notice it's, let me just turn back one page. Do you see how much smaller that is? And this is larger. Do you see that? Can you see just the actual type is larger? Do you see that?
Yes.
Okay, that's not by mistake. This is a 1040 special for senior citizens. This is, now I'm not speaking out of school, this is fact. Look at the top left-hand side of the 1040. It's actually called the 1040 SR for seniors. And this is not to offend, it's just, it is what it is. That the IRS that manages the process decided to create a version of the 1040 with larger print. Seriously, for seniors, seriously. Now look at this. Now, if you look at the, let's look at the pension down under 4C and 4D, using our example, our model, we would use 4C, 26,746. What dollar amount would George, the CPA, use? Pardon me, 24,933. Absolutely. What about Social Security benefit? We would use the 23,070. Just by way of review, what would George use? 6713 over to the right, 5B. Just a thought. And this back end we can see, and then the itemized deductions. And that's it. Before we leave the personal 1040 and the personal discussion, meaning for primarily business owners, do you have any questions? Michelle, do you have any questions before we leave this and go back to the main PowerPoint? Any
I do not,
questions?
thank you.
You bet. Shahida, any questions? And Haley on the chat, if you can go ahead and, pardon me, type into the chat. Do you have any questions before we move back to the main PowerPoint? Okay, no questions, no questions. Thank you. All right, let's move forward. Everyone, if you will take the exhibit 1 and put it to the side, and then just to the left of you, just pull it right over your main PowerPoint. Give me just a second. Let me stop sharing this, and I'll share, go back and share the main PowerPoint. There we go. Okay, so we did page number 5, the full cash flow model, including using, of course, on page 6, the tax forms. All right, let's move to page number 7. We'll stop right there and we'll take a half-hour lunch break. Everyone will come back about 12:30 your time and we'll continue, but we're going to shift to the business side. Thank you, everyone. Excellent participation. During the break, if you think of any questions, we'll start off right after lunch with covering or answering those questions. Have a good lunch, everyone. Talk to you in about 30 minutes. Bye now. Talk to you in about 12:30. Welcome back, everyone. Hope you had a good lunch, and we'll get started in just a moment. If you go ahead and get back in and unmute yourself, if you would, that'd be great. We're ready to go. Anyway. Okay, Kobe, are you back with us? Wait just a moment. Oh, Kobe,
Yes,
are
I'm
you-
here.
Oh, excellent.
Yep,
Thank
I'm
you
here.
thank you for doing the sound check. Thank you so much.
I'm
And like I
here.
said, you notice I do that at the end of each break because you never know when system, even though it may show it's down. Okay, let's roll forward. We're going to shift thought. Even though we've been doing business cash flow and business tax return analysis extensively in the form of Schedule C and even Schedule F, if you will. Those are the two big ones we've already covered. Sole proprietor or single member LLC, and then Schedule F on the farm, which we're going to see in a moment is similar model. Those, of course, are embedded or buried within the 1040 or part of the 1040 personal return. Now we're going to be looking, though, at what I call freestanding tax forms. The 1120 for the C Corp, the 1120S, as you can see down below on B, the S Corp, and then turning to page number 8, the 1065 on the partnership or LLC. Let's turn back to page number 7. And these are the three big freestanding businesses we're going to emphasize. The C Corp is an old-fashioned structure, okay? The C Corp, they've been around for hundreds of years, 150, 200 years or more in America. The form, once again, is the 1120. From a tax structure standpoint, what is the huge negative on the C Corp? Well, it's the double taxation, you can see under A2. The corporation pays tax on its profitability, and then it turns around and pays tax, and then, then it distributes the after-tax profits to the shareholders in the form of a dividend. And then the shareholders have to pay tax on the dividends. It's a double negative. And it's real. This whole concept of double taxation is real. Now, there are some limitations and some extensive what ifs and what have you, but generally speaking, this is still in place and has been for many, many years in America. Now, that's the negative, the A2, but look at A3, the positive to this particular business structure from a tax standpoint or tax structure. Pardon me, unlimited number of shareholders. For example, Walmart. Walmart may have 10, 20, 30,000 shareholders. Essentially, all publicly traded corporations are C Corps, simply because of the number of their shareholders. Now look down below under page 7 here, under Part B, the S Corp. If you'd please add this to your notes, 1958, the S Corp. Now, in 1958, the first S Corps were approved or allowed from a tax standpoint, okay? The form is the 1120S. Look at Part B2. This is a huge positive to the S Corp. No double taxation. The profit or loss from the S Corp flows through to, if Bob and Sue, instead of ABC LLC, it was ABC S Corp, flow through to Bob and Sue, and they're taxed once at the individual quote unquote principal or the business owner level. That is huge. But there are limitations. Look at number 3. In an S Corp, you can only have, by its structure, up to 100 shareholders. It used to be, and I add this to your notes, it used to be, just a few years back, it used to be 35, then it went to 75. Now it's up to 100 shareholders. Okay, it's up to 100 shareholders. Now, look at the next little phrase. if you bank an S Corp, if you bank a family-owned S Corp, up to 6 generations of that family can be represented by one shareholder. Okay, let me illustrate. I was in the Midwest a couple of years ago doing a ground-based session providing a ground-based session with primarily credit analysts / loan officers like yourselves. Pretty much the same type of group. And it was ground-based. Well, we took a break. We had talked about the S Corp. We took a break right after. One of the credit analysts from one of the banks, there was multiple banks represented in the session. One of the bankers came up to me, one of the credit analysts, and he goes, "You won't believe this. My bank is an S Corp, which is a little unusual. Most banks are actually C Corps." But he says, "Well, it's family owned." And it was like, he'd been in the family for like 3 generations. And of course I asked him, "Well, are you part of the family?" He goes, "Oh no, unfortunately not." And we laughed and he laughed and I laughed. And he goes, "I'm an employee, but I'm not also a family." But he said, "We have about, like 20 or 30 family members in the bank." And he said, when we converted from a C to an S, which is partly so that they avoid the double taxation and a lot of other issues, he said, Grandma, and he called her Grandma, he says, Grandma controls the stock representing the ownership of the 20 or 30 family members that are employees in the bank. She's retired, but she's, and like I said, this was like a 3rd generation bank. So it had been started, I don't know, her dad or her grandpa or whoever. He told me, the credit analyst told me, 99 non-family member shareholders in the bank. Exactly, he said. I said, "No way." He goes, "Exactly." And then the grandma representing the family. And he said, the family actually controls the bank because the number of shares and so forth, she controls it, representing the family. Interesting. Now I need to ask a question. If you have a married couple, like Bob and Sue, our example we've been using throughout the session, if you have a married couple and they were to set up an S Corp, would that be considered one shareholder or 2? In light of this discussion on B3 at the bottom of this page, think of it. Think about it. I'm going to ask Heather. Heather, just take a stab at it. Do you think there would be, if you had a married couple today, 2021, and they set up an S Corp, would they be considered as one shareholder or 2 if they were to set up an S Corp? What would you say? Just take a stab at it. Just take a guess.
1.
1. Okay. Christian, are you back with us? If Christian's there, if you could unmute, what would you say? 1 or 2, Christian? Okay. 1 or 2. Anar, what would you say? What would you say? 1 or 2?
If they are filing jointly, then 1.
1. Okay. No. Let me clarify. I'm talking about just the S Corp, not the personal return, the S, the 1120S. If
Yes.
they were to set up, would it be 1 or 2 shareholders?
1, I guess.
1. You say 1. Okay. No problem. Thank you. Michelle, what would you say? 1 or 2?
1.
1. The answer is 2. I'd add this to your notes at the bottom of this page. Just because you're married to this person, the way the tax law is in America today, it's interesting because in my lifetime, it's changed. In my career, it's changed. Years and years ago, it would have been 1. But today it's 2. Just because you're married to that person, you're not family. You have your separate rights, even though you're married. It's kind of an interesting twist. But in the tax code, like a lot of the laws have changed over time in America relative to married parties or married persons or whatever it's called. Now, the only exception is if the married couple is within 6 generations of each other. For example, Queen Elizabeth, her husband passed about 3 weeks ago, whatever, Prince Philip. married couple. And you're thinking, well, if before he passed, if they were to set up an S corp in the US, would it be considered one shareholder or two? Well, per this discussion, it would be two. No, it would actually be one. Why? Queen Elizabeth and Prince Philip on one side of the family are third cousins. On the other side of the family, they're second cousins. I'm serious. Why? Because of the royalty. Traditionally in Europe, the royal families is all in the family, if you will, all the controlling the politics, controlling the country, seriously. So they were actually distant cousins, but within 6 generations. Interesting. Moving right along. But for most applications, married couple, 2. Let's turn to page number 8 now. LLC, the most common borrowing entity, hands down. Shahida and Haley, if you'll type into the chat, what is your most common borrowing entity from a business standpoint? Is it the S, or is it the C Corp, S Corp, or is it the LLC? Most banks and most settings it's LLC, but let's confirm it with Shahida and with Haley. Okay. All right. Shahida says LLC. Haley says, I'd say it would be the LLC as well. Excellent. Thank you. Okay, now, why is it so popular? Well, first off, it's the 1065, mentioned that a moment ago, but I would highlight or circle number 2. This is why the LLC is so outrageously popular. And the LLC is a combination of a C Corp and a partnership. It's a combo of a C Corp and a partnership. Let's start with partnership. Now I want to clarify, this is multi-members, 2 or more members. We in the bank call them members. George, the CPA, by the way, calls them partners. Why? Because they file a partnership tax return, a 1065. By having 2 or more partners, and you can see number 4 down below, single member, we talked about extensively before the lunch break, now multi-member. By having multi-member, they get to file a 1065, 2 or more members. And one member could just be, nominal, 1% ownership or something like that. Not to speak out of school, my wife has an LLC. Well, I am a whopping, this is personal, but I'll share it. I have no qualms sharing it. My wife is a 99% owner of her LLC, and I'm a whopping 1%. That's all I am, which is great. That's all we need. Multi-member. The problem with being a single member, remember we talked about the problem with the Schedule C, 4 times more likely audit, on the crosshair of the IRS. Well, give us somebody a nominal 1% or 0.005% of the LLC. It's just an idea. Now, going back to partnership under number 2. A partnership tax structure, which of course the Forms 1065 we'll see momentarily, gives flexibility in the way the distribution is made from the business to the business owners, to the members or partners. So, but that's the positive of a partnership. But the huge negative of a partnership from a legal liability perspective is that the partner, or partners, I should say, are individually and severally liable from a legal perspective in a partnership, seriously. So, someone in 1977, I put this in your notes at the top right side of this page, in the state of Wyoming, created the first LLC. Well, what did they do? Well, they figured out, they said, well, wait a minute. Why don't we take the tax flexibility of a partnership and combine it with the limited legal liability of a C Corp. Because an old-fashioned partnership does not have what's called a corporation, whether it's a C or an S, is called the corporate veil, or the curtain that protects the cloak, or the curtain that protects the corporation. So somebody figured out, we'll take tax flexibility of the partnership, which means the way the distributions are made from the business to the owners, to the partners or members, we call them, can vary. It's not based on their ownership per se. But unlike an old-fashioned partnership, where the partners are individually and severally liable, which is a huge negative legally, an LLC is a C Corp. Most states do not allow them until the mid-90s, believe it or not. Now, why Wyoming? Wyoming is one of 3 states that are flexible in their business structure, real flexible. Kobe, Wyoming is one of them. Can you name one of the other 2? Any ideas what the other 2 states would be that are real flexible?
So Florida,
Not Florida, not Florida. Thank you,
Texas?
Heather. Pardon me, not Texas. Heather, how about you? Heather, can you name either of the other 2 states?
I have no idea.
No problem, no problem. Nevada, where I'm based, and this is the big one, Delaware. You may have heard or may remember, Delaware is traditionally where a lot of corporations are set up. I'm talking about for the last 80 years or whatever from right now, nationwide. Most publicly traded corporations in America are to this day incorporated in what state? Delaware. Delaware reached out years ago, decades ago, and became like the haven for setting up businesses. Seriously, not LLCs, but big publicly traded corporations. Moving right along now. So the LLC is tax flexibility combined with limited liability. Let me illustrate. Okay. Before we do so, if you'll turn back 1 page to page 7 to the S Corp. On the bottom of this page, if you please add this to your notes, this is just a what if scenario. You have 3 shareholders in an S Corp. This is privately held. This is not publicly traded, of course, privately held. And they own the S Corp a third, and a third. The shareholders do. Okay. All distributions from the business to the business owners to the shareholders, whether it's a positive number or a negative number, must be a third, and a third. So if there's a $300,000 profit that's going to flow from the S Corp to the shareholders, and they own it a third, a third, it must be 100, 100, 100. It must be that way. Or if there's a loss for 300,000, either way, 300,000 flows through, 100, 100, 100 negative to each. Okay. If the S Corp switches that around a little bit, gives $150,000 profit to shareholder number 1, or if the loss a negative 150, they could blow the S status, and the IRS can say, you're not really an S Corp. You're a C Corp up above A2. You're subject to double taxation. Okay. That lays the groundwork if you turn forward to page 8. The bottom of this page, if you'd add this to your notes, if we have an LLC, here's an LLC with 3 owners, and we call them partners or members like we do in the bank, and they own the LLC, and it's taxed as a partnership, a third, and a third. Okay. And there's $300,000 profit that's going to flow from the business to the owners. You would naturally think, like the S Corp, oh, we'll give 100, 100, 100. Or if it's a $300,000 loss, we'll give each a negative 100, negative 100, negative 100. Okay. But because it's taxed as a partnership, we're not subject like the S Corp based upon ownership. In an LLC partnership, we could give all $300,000 profit to partner one and zero to the other two people. Or we could give partner one the $300,000 loss and zero to the other two partners. Now, from a tax strategy standpoint, why in the world would this LLC do this? Well, George comes to the three partners. Hey, you're going to get a $300,000 profit. And all three partners just think, well, members of the LLC partners, we're going to each get 100,000 that will pass through to us. We'll end up paying our personal share of the tax. But George says, oh, wait a minute, guys. Let's be smarter with the tax strategy. Do any of you know, are you going to get an unrelated loss, meaning from another LLC that's not this LLC, that's going to pass through to you that we can offset? Partner number one raises his hand and he goes, you're not going to believe it. I met with my CPA yesterday and she told me I have a $300,000 loss that's going to pass through me from an unrelated LLC. The other two partners look at him and go, hey, can we put the whole 300 to you? Positive. Absolutely. And George goes, let's do it. They give that partner one the $300,000 profit, flows through to partner one. The $300,000 loss from the unrelated LLC flows through to him as well on the other side. The two match up, completely eliminates any tax. Any tax. Wow. Okay. A year later, George meets with them. Hey, I got good news from a tax standpoint. You guys are going to have a $300,000 loss. And all of them were thinking, the two and three, partner 2 and 3, oh, we get our 100 loss because, oh, we can offset that against, I've got some other profit coming through from other LLCs. Partner number one goes, no way. What do you mean? No, I helped the team out last year. I met with my personal CPA yesterday. She informed me, I have got a $300,000 profit flowing through from an unrelated LLC. I need that $300,000 loss so that I wipe out any tax owed. The partner 2 and partner 3 look at him and go, okay, yeah, you helped us out last year. Fine, you take it all. You could not do this in an LLC, in an S Corp. You'd blow the S status, become a C Corp, double taxation. I am serious. This is the next step of why number 2 is the reason why the LLC, in other words, taking step number 2, bullet point 2 here, the combo of the partnership with the C Corp. But this is beyond, but this is why the LLC is so outrageously popular. Okay, now you may say, do people really do this? Do business partners do this? Do business families do this? Oh, absolutely. My personal opinion, the business families and business partners, they may not be family, but they're close, that win the best at the, I don't take this wrong, the game of tax or the strategy of tax are those that will work together like I just described. Absolutely. Because in the end, this business family, oh, it doesn't matter. In the end, they're all going to win. Absolutely. Or these close partners. Oh, absolutely. One of the banks I worked at when I was on your side of the table started by 2 partners. And they weren't family, 2 partners. In fact, they came from diverse backgrounds, even diverse parts of the country. They were partners in multiple businesses, including the bank, founding the bank, multi-billion-dollar bank in the end, before they both passed. And the families are still involved, so forth, what have you, the 2 families, and they're close. They were involved in 50 businesses, 100 businesses over the years. They were partners for over 50 years, 50, non-family, non-blood, but tight. Those type of guys, those two guys, they do this all day long. They didn't care less. They say, well, you're going to get a little more benefit than me. No way. Anar, any questions on this? The benefits or why the LLC is so popular as a structure? Any questions, Anar?
No.
Okay, thank you. Michelle, any questions, Michelle?
All good,
Any-
thank you.
Okay, good. Thank you. Let's move forward. No double taxation. We talked about single member versus multi-member. What is a series LLC? And I know this because I gave a class for another group in Michigan just the other day, different group and different subject matter. And so I know the answer to this. I put in your notes, Michigan does not allow it. But Christian, I don't know if Christian is having problems with technology. Christian, if you are, you can just chime in with the chat for this afternoon's portion of the presentation of the webinar. But Illinois does allow it. I know this for a fact because I train in Illinois. Illinois doesn't allow it. Probably I said that backwards. Michigan does not allow it right now. Illinois does. What is the series LLC? Let me describe it. Bob and Sue. We've talked about Bob and Sue and ABC LLC, small manufacturing firm. Let's say instead of being a manufacturer, let's say that Bob and Sue's company, ABC LLC, they're a commercial real estate developer, and they own 10 buildings, commercial buildings around the state. They even have one up in Marquette, or a couple up in Marquette Market in that area. They've got one over in Grand Rapids. They've got a couple in Lansing, one in East Lansing. They've got one in Ann Arbor. So they've got, and a couple in the Detroit market. So 10 buildings. Traditionally, they would have how many LLCs? 10 LLCs. Modern America. This is modern. Hasn't been around that long. Used to be only 4 or 5 states allow it. Now it's up to about 20 states. Michigan's still not there. Illinois is there. Illinois has it approved for a few years at least. They have one master LLC known as the series. These are the 10 properties. Instead of 10 different LLCs, 10 different filings with Secretary of State in Lansing, 10 different tax returns, no way. And if Bob and Sue have ownership in each, that would be 20 K1s, one each times the 10. So 2 times 10 or 20. One LLC. Property 1 is in Pod A. Property 2 is in Pod B. Property 3 is in Pod C, all the way down to number 10. Modern America. Oh, it's the wave of the future. I suspect Michigan is just a matter of time. Illinois is already there. And a few other states in the upper Midwest are already approved of the 20 states. Nevada is because it's flexible, and other states, of course, in that mix of 20. And my observation over just the last 2 years or less, more and more states are approving it. Just a thought. Okay, any questions on that? Shahida, any questions on that, on the series LLC? Kind of this from a structural standpoint. And it ties into tax because you have one tax return versus 10. Any questions on that, if you would? Any questions? Okay, no questions. Thank you. All right, let's move forward. Turn, if you will, to page number 9. Now, page 9, the cash flow for the freestanding C Corp, S Corp, or LLC. It's the EBITDA. We've covered this, like I mentioned this. We've covered this in the Schedule C, the Schedule F, and so forth. But now it's the freestanding business. Now, net income or net income, net loss earnings, we add back the interest expense. We talked about this. Well, why do we add it back in? Remember, it's already netted out of the net income or net loss of the business. plus we have the debt service, the P&I principal and interest down below. As I mentioned on the Schedule C, if we don't add back the interest expense, we have quote unquote double dinged the cash flow. Why? Well, we take out the interest down below at the debt service. That's number one. Number two, the net income up above is already net of the interest expense. So we've got to add it back in. We'll skip the taxes for a moment. We discussed extensively depreciation, amortization, depletion earlier. Same concept here as we did on the Schedule C. So we could have the EBITDA with including depletion. Let's go back to the taxes. Why do we add back taxes, or where would we add back taxes? If you would please put a little note next to taxes, only if it's a C Corp. Only if it's a C Corp. Okay, Haley, do you see many C Corps? Up in the UP where you're at, do you see many C Corps? And while she answers that, Kobe, do you see many C Corps in your world right now? Or are you dealing more with LLCs and S Corps?
Not a whole lot.
Of C
Don't
Corps,
see.
right? C Corps, okay.
Yep.
Got it. Heather, how about you? In your world, do you see many C Corps, or are they more S Corps or LLCs? Okay. Okay. All right. Haley, not a whole lot. And Shahida, no, I've not come across any C Corps. That's common, depending on where you're at in the bank. Pardon me, Heather, Heather, if you're with this, Heather, do you see many C Corps in your world? Okay. Anar, do you see many C Corps in your area of the bank where you're at?
Not a lot.
Okay, so not a lot as well. Okay, good. All right. Moving forward. If you do have a C Corp, it is of the three main businesses we're covering today. Pardon me, it is the only one that is a tax-paying entity. The C Corp is an actual freestanding tax-paying entity. Remember the S Corp, remember the LLC or partnership, those flow through from the business to the business owners, but not in a C Corp. A C Corp, as we mentioned earlier, the double taxation, they pay tax. Now, why do we add back the T of taxes for a C Corp? It's because the income taxes for a C Corp are considered non-operating expenses. I'd add that to your notes, please. They're considered non-operating expenses. What does that really mean? Well, when they pay the tax, it's on the profitability, but it's after the normal operations of the business, the C Corp. So it's a non-operating expense. It's not a regular expense of the company. It can vary depending on the tax code and their tax strategy and so forth. So we add it back in because it's a non-operating expense, the T of taxes in a C Corp. But for several of you, well, I don't really hardly even see these, if ever. And that's common, by the way, nationwide. So I work with lenders all over the country. Oh, it's common. Even in a ground base where I'll have 20 or 25 people, and there's like, say, 6, 7 banks represented in the room, maybe even 8. Maybe out of the 20, 25 people, maybe 2 of the lenders even really see them much. EBITDA inflow, kind of like we did before in the previous models, like in the C Corp, or probably the Schedule C or the Schedule F, minus the debt service, gives us the margin. EBITDA inflow divided by the debt service gives us the DCR. So EBITDA inflow minus the debt service gives us the raw number margin or excess. Pardon me, the EBITDA inflow divided by the outflow debt service P&I gives us the DCR, debt coverage ratio, or your bank may call it DSCR. Michelle, in your bank in Crestmark, do you call it DCR? I don't recall, or is it DSCR?
DSCR.
DSCR, debt service coverage ratio. That's actually in some states more common than DCR. Other states are DCR, but mathematically it's exactly the same thing, literally the same thing. So if you ever see DCR and yours is DSCR, don't let it throw you off. It's the same thing. What is the minimum standard on this one? Okay, we're going to ask Shahida, in your world, and we're recognized with the group from Crestmark there, you got, from various parts of the bank. Shahida, what's your minimum DCR for the business cash flow? Can you type that into the chat if you would? What's your minimum? Here, boy, the chat, this is excellent. I want to compliment the people in the chat. Very quick today. Quicker than even normal. I mean, it's really quick. 1.20 as well. Excellent, Shahida. Now, what does this really mean? Well, how do you interpret the 1.20? For every $1.20 of inflow, there's $1 outflow. $1.20 in, $1 out. So there's a cushion. We saw the same figure on the personal for Bob and Sue. Their personal cash flow as business owners, if you will. Excellent. Pardon me, let's move forward. Page number 10. Page number 10, the business tax forms exhibit 2. Now, before we go there, like we did before, if you'll turn back to page number 9, and then if you'll take your main PowerPoint packet and keep it open to page 9, of course, just flip it to the left. And then if you'll put exhibit 2 right in front of you, and give me just a second, and I'll put exhibit 2. I'll share that on the screen. Okay, give me just a second here. Okay. All right. Okay. Give me just a second. Okay. Give me just a second. Some reason it's not pulling up. Okay, I've got it on my screen. Let me just share that with you. Give me a second here. Okay. Boy, give me just a second. Well, that's weird. It's just, for some reason, it is not clicking through. Okay, here we go. Finally, there it is. Okay. Kobe, can you see exhibit 2 on your screen?
Yes.
Excellent. Thank you for doing that check for me. Yeah, so every once in a while, Zoom just kind of drops it out. Now, let's go ahead. We're going to spend a few minutes on this, going into the business tax forms and extracting, of course, the cash flow like we did on the personal, but on the business side. And then we'll take our first break of the afternoon in just a moment. So everyone, we should have exhibit 2 right in front of us. Exhibit 2, of course, is on your screen, and to the left of you is page number 9 from the main PowerPoint, the cash flow. We can just toggle back and forth. You can just look back and forth on that. Now let's look at the actual, we're going to start with the 1065. This is on the partnership or LLC. We're going to start with the most common borrowing entity and then go to the S Corp and then to the C Corp in that order. And then we'll look at some live examples like we did on the personal as well. So here we go. Let's do the cash flow model first on this LLC. You grab your highlighter and your hard copy right there in front of you. And this is for the LLC partnership, line number 22. And you could even put on your hard copy at the bottom or maybe to the side with your pen, just the little code system, if you will. Line number 22, business income, net loss. Add back earnings before interest. Line number 15, interest. There is no taxes because this is an LLC. But if you look under, pardon me, if you look up under line number 14, do you see where it says taxes and licenses? I would take your pen and just slash through that. That's not income tax. That's like property tax, some other tax or form of tax, property tax or whatever. So don't be confused, don't add that back in. So earnings before interest, no taxes. Line number 16A, depreciation. Line number 20. This is other deductions to the right of that. On those little dots, I would put the word amortization question mark. C statement in the back. Pardon me, C statement in the back of the return. It's usually going to be statement 1, 2, or 3 if it exists. And then lastly, line number 17, depletion. Once again, line number 22, net income or net loss. Add back line number 15, interest. Add back 16A, depreciation. Add back line number 20, amortization if it exists in the back of the return. Lastly, add back line number 17, depletion. It's our basic EBITDA, but with no T, EBITDA formula. Moving right along. Any questions on that? First cash flow. Heather, do you have any questions on that for the LLC? Any questions?
No, not at this time.
Okay, got it. Thank you. Okay, let's move forward. Here we go. Now, let's turn about to page number 5. Just turn forward. This, of course, is the balance sheet. Now, this is not populated. It is just the blank forms. We'll see some examples, as I mentioned, with dollar amounts. But let's look at Schedule M1 and M2. Sometimes commercial lenders get a little kind of tripped up or, on these two. Schedule M1 is simply the reconciliation between the income of the business per its books, meaning the financial statements, and the income of the business per this tax return. To keep your borrower honest, if you would highlight line number 1, net income loss per books. Okay, now, before we go into this deeper, I want to emphasize, I'm not accusing any of your borrowers being dishonest, but this does happen. If you want to keep your borrower honest, this is a simple little technique. You obtain their tax return, and this is year-end 12/31 of 20. But you also get or obtain from Jane, the CFO, the company's company prepared financial statement as of 12/31 of 20. Okay. So 12/31 of 20, 12/31 of 20. Okay. Here on line number 1 in Schedule M1, please highlight that, put a little note. If they say to the IRS essentially, hey, our income per our books or financial statement is $300,000. Okay, fine. But when you look at the company prepared financial statement, it better match what they're telling the IRS it is. So on this tax form, if they say, oh, the net income per books is 300,000, and it's right here on Schedule M1, line 1. But you also have the company prepared financial statement, and the net income shows 400,000. What? If it's a couple of thousand off, no big deal, but 100,000, no way. They're lying to the IRS. I don't mean to accuse them of lying, but that's really what it is. Most likely. Now, there could be some explanation, but most likely. I had this happen when I was on your side of the table. Gentleman applied for, it was like a $200,000 equipment loan or what have you. Gives me all his financials. We banked him already, his deposits and some small loans. So this was a little larger for his business. Well, he gives me his 3 years of personal tax returns, all the schedules, personal financial statement, company prepared financial statement, accounts receivable, AR, accounts receivable, AP, accounts payable, agent reports, everything, but not the business tax return. I said, hey, we need that. Oh, no, you don't. As soon as a customer or borrower of your bank starts to say, oh, you don't need this, or you don't need that, or you don't need to do that, or you don't need that info. Oh, that is a red flag. Oh, we need that. So I told him we need it. Week later, he called me at the bank. Hey, have you got that loan approved? I said, no, I haven't even started on it. What? I said, I need the business tax returns. I said, I can't even start. Sure enough, that afternoon, his runner brings him by the bank. I already had the company prepared, 400,000 net income, net profit, which he wanted me to use to do the cash flow modeling. I opened to this page on the tax return, shows 300,000. I showed it to my boss. She looks at me, I looked at her, and we said, this looks like a decline. This guy's playing games. We both blurted out simultaneously to each other. Did I accuse him and say, we can't do the loan because you're a tax cheat or you're playing games? No. But my boss and I looked at the numbers. We looked at some of the key ratios. His liquidity was weak in his business. His leverage was high, and on and on and on. And we declined the deal. But the real reason is we didn't trust him. Do we accuse our clients of tax cheats? No. If we do, we could get the double L. What's the double L? We'll come back to this in our third section briefly. It's called the lender liability. We don't want to go there. Let's go to M2. M2 is simply the reconciliation of the partner or capital account of the business. You may remember from your accounting classes or what have you, or training, you may have had a webinar or two or what have you, or a seminar. You've got beginning capital, then we add what was contributed. We add also the profit or take away the loss. Over on line number 6, bottom right-hand side, line 6, we take out the distribution, meaning it's because it's cash outlay, and then we have the ending balance. That's all it is, just a reconciliation of the capital account. Let's move forward. 4562, we'll take this, and then we'll take our first afternoon break. Okay, 4562, I'd highlight this. This is the depreciation. Now, there are 3 forms of depreciation major that your clients could use. We're going to talk about the two that are the most basic. We'll save the other one for the advanced tax class in September. Okay. Now, let's start with part 3. Bottom left-hand side of the page, you see MACRS. MACRS, this acronym stands for Modified Accelerated Cost Recovery System. Modified Accelerated Cost Recovery System. Okay, here we go. This is the most common form of depreciation you'll see. This is also the form of depreciation that essentially all commercial lenders in America today add back into our EBITDA formula, the EBI, or earnings before interest, depreciation, amortization, depletion for the LLC or partnership, or if it's a C Corp with the T's included, tax. This depreciation, essentially everybody adds it back in as a non-cash expenditure. Look under 1980, see the 3-year property? To the right of that, if you please put computer, okay? What about 5-year? Part 19B, a vehicle, a piece of equipment. Look at 7-year to 25 years, different levels of an aircraft, meaning a smaller corporate, jet or corporate plane, maybe 5 or maybe 7, 10, 15, large, like, United Airline type, 777, 737, whatever, 25-year depreciation. Look at Part H, residential rental. This is Bob and Sue's rental house, 27.5 years in the middle of the page over to the right. Look at Part I, non-residential. Now, this is primarily commercial buildings, but this could be other buildings that we don't think of as straight commercial or completely commercial, not straight up. They're not commercial, possibly farm, the buildings on the farm, if you will. Those are not really considered commercial, but they are 39 years. Look at the middle over to the right. Wow, that's the schedule. Everybody adds this type of depreciation back in, as I mentioned. Now let's go up and let's look at the second form that we're going to discuss today. Look at the top middle of page of this under part 1, pardon me. You see section 179. Now this is accelerated depreciation. Makers is actually considered accelerated, modified accelerated cost recovery system, but section 179 is even more. It's where the borrower borrows the money to buy that equipment and in 1 year writes off the equipment to depreciation, the entire piece. Manufacturing piece of equipment, farm equipment, you name it. Top right hand side of this little section, you'll see number 1, 2, 3, 4, and 5. Under number 1, pardon me, if you would please put 1,040,000. This is under box 1 at the top right. 1,040,000. Box 2, 750,000, 750. What about box 3? It's a little over 2.5 million. I put 2.5 million, a little over. This is in 20 and 21. It's a little over 2.6 million. It's just ratcheted up a little bit. So it's over 2.5 million. Okay, so I just put 2.5 on box 3. Now what is this? Section 179 allows Bob and Sue, ABC LLC, whether they're the manufacturer in the Detroit market, maybe they're in the UP, maybe they're a farm in the UP, outside of Escanaba, or in some other area. The 1,040,000 says in the section 179, as long as they don't purchase overall during the year, number 3, 2.5 plus million in a new equipment, you can write off up to 1,040,000 in 1 year. Down below under 19B, 5-year, that's what it typically is. Stretched out 5 years. This is one shot. It's all done. Now, what's the number 2, 750? I just made up that number. That's how much the equipment is truly that they bought. So let's say ABC LLC only bought $750,000 worth of equipment. They bought no other equipment, so they're way below the 2.5 plus million. And they're even below the 1,040,000, which is the max on this write-off. 750 in one shot, not over a 5-year stretched out period, in 1 year. This is huge tax benefit. Now, for whatever's worth, before the TCJA, before the Tax Cuts and Jobs Act came about, it was only a little over 500,000. It basically doubled to 1 million. Now it's up to 1 million in 20, 1,040,000, and 21, 1,050,000. Wow, but it doubled. essentially from 17 to 18. That's on the tax side. If you'd please put this note, a little note at the top of this page, if you don't mind, please. How do we handle this cash flow wise? Well, pardon me, this is a controversy in our industry and has been for decades. It's about a 60-40 split, 60-40. 60% of most lenders today, banks today, do not add back Section 179, 40% do. Okay. Anar, do you know, in your bank, do you add back Section 179 depreciation? Do you know?
Trying to remember, we definitely do add back depreciation, yes.
Okay, now is it makers down below, the regular, or is it the Section 179, which is, where they write off the piece of equipment all in 1 year? You-
The regular, I don't remember this one.
Okay, no problem, no problem. Michelle, in your area of the bank, do you add back Section 179 or not?
We don't, just the normal depreciation.
So you just part 3 down below. So you play the conservative, the 60%. Okay, good.
You're right.
Okay. Okay, I'm going to ask one more individual. Shahida, would you type in the chat? Do you, and I know many of you are in the same bank, but you're like different worlds or different departments. Let's see if she adds it back in. Same as Michelle. Okay, don't add it back in. More conservative. You're the 60% people. Now, what is the 60%? Well, 60% of all commercial underwriters nationwide today, approximately, don't add it back in, meaning it's conservative. It's like, and why don't we add it back in? Because if they buy this piece of equipment for the manufacturing firm, $750,000, or the farm operation, either way, well, you got to say to yourself, wait a minute. If they add back, if they've depreciated that all in one shot in 1 year, and they write it off all in 1 year, they've dished out the cash to buy the equipment 1 year. Why are we going to add back the depreciation? No, down below the 5 years, they dish out the cash the first year to buy the equipment, and then you have true year 2, 3, 4, and 5 non-cash expenditures. We just add it all back, even that first year traditionally down below. But here, we don't add back fuel expense. We don't add back salary expense. Those are true cash outlays, all in the same year. So why, if you're writing off the entire purchase of the asset, the equipment, and you're dishing out the cash same year, well, why would we add it back in? We play it conservative. We don't. Here's arguments. Here are 2 arguments to argue in favor of the 40%. Number one, the number one argument, no particular order, but number one thought, whose cash was it to buy the equipment? It was the banks. Now, we may say we may require a 10 or 15 or 20% down payment, but the vast majority of the cash was the bank's cash. So some lenders say, we're gonna add it back in, because it was really our loan in the form of the cash from our loan. Even though it went through the company's books, the borrower's books, it's really our cash. Here's a second argument to add it back in. What if Bob and Sue's company, ABC LLC, the manufacturer or the farm, what if they only buy equipment once every 5 or 6 or 7 years? It's a non-recurring event. We talked about recurring, non-recurring. So you say, well, this is a non-recurring. It's not going to happen every year. It's odd. So why don't we add it back in? That's a second argument. No matter what you do as a bank, my recommendation is that you be consistent. Let me just illustrate. When I was on your side of the table, I worked at a bank. We had 4 lending centers in the same town, in the same metro area. pardon me. 3 of the 4 lending centers, we had like 3 or 4 lenders in each center and a manager, so a team of about 5, some support people, maybe 8 people on each team, 4 of them around the metro. 3 of the 4 of the lending centers, all of the lenders did not add back section 179. One of them did. One of them said, I don't care what you guys do, we're going to add it back in. Well, bizarre. Same bank, same senior management, same loan committee downtown. And when you go to loan committee, you'd see one of the lenders from that 4th team. You knew you were at a disadvantage from them. Why? They're adding back section 179. Their cash flow models were, quote unquote, slang term, were beefed up versus ours. True story. No matter what you do as a bank, I beg of you, be consistent. Everybody does it either one way or the other. Now, there was a comment. Hold on one second. All right. There was a comment from Shahida. Okay. We have not done in the past, though. Okay. All right. Good. So you could change. Now, the bank, very good point. Your bank could actually change. Like, well, we're not adding it, we now are, or we were adding, now we're not, or whatever. But if you make a type of change like that in your underwriting, be consistent. My recommendation, all the lenders on the same page. Everybody gets the email at the same time. This is our new direction, if you will. Let's move forward. Turn forward about 2 pages to the K1. We'll stop right there. Let's take a 5-minute break. We'll come on back. But before we take our break, are there any questions over this last little section? Any questions? Okay, talk to you in 5 minutes, everyone. Thank you so much. Welcome back, everyone. Take just a moment. We'll get started. Okay, here we go. Michelle, can you do our sound check for us, please?
Yep, I'm with you.
Excellent. Thank you so much. Has anyone, and I just want to ask, just to clarify before we go forward, has anyone joined us from Crestmark that we haven't heard? That you know, I'm going through the names and everyone participating, excellent. But do we have anyone else? I just want to make sure that if you can join the audio or even on the chat, that we have everyone, just to make sure we're answering any questions or what have you. Is anyone new to the group or from either Crestmark or even another bank? Okay, all right. Next item, before we jump forward into the K1s, everybody, if you could write this down maybe on a separate pad or sticky note or whatever, I'm going to just give you just a minute before we get back in the material. Let me give you the dates and topics of the sessions in Lansing. Now, these will be in Lansing, hopefully ground-based. Pardon me, these may be Zoom-based, but they, you know, depending on the circumstance with COVID and the numbers and so forth. Wednesday, September 15th, we're going to have a full day on advanced financial statement and cash flow analysis. So Wednesday, September 15th, advanced financial statement and cash flow analysis. Thursday, September 16th is our advanced tax class. So we'll use the foundation, these same exhibits, but we're going to emphasize primarily tax strategy for the business owner, small to medium-sized business owners that you as a lender should be aware of, legitimate tax strategies and so forth. So September 16th, advanced tax. Friday, September 17th, in the morning, C&I lending, in the afternoon, CRE lending. So Friday the 17th, C&I in the morning, commercial industrial, lines of credit, equipment loans primarily, and then in the afternoon, primarily commercial real estate. Now, you don't have to take the whole series. It's encouraged. We encourage you to do so. You can, you know, you can take two of the three or one of the three or all three. But I find that a lot of people will just, they'll just block it out and take the whole series because it all ties together. These are considered advanced, of course. But if this applies to you, which several of you, I suspect this would apply to, and or some maybe your coworkers that are not in the session today. Okay, just thought I'd mention that. Now you will receive an email with the, you know, the outline, the brochure and so forth. Thought I'd just mention that up front. Now let's go forward. The K1. Now this is the K1 for the LLC partnership. It's a little different than the K1 for the S Corp. Pardon me, if you'll look with me down below, do you see on the bottom right-hand side of this K1 where it says for IRS use only? Let's just use that little blank spot just to keep it simple. This is the formula. It is as follows. 19A. Now we don't see the letters because, or not all the letters because the numbers are not populated, but it's 19A plus 4C minus box L capital contributed. It is box 19A plus 4C minus box L capital contributed. Okay. So 19A is the distribution. Capital distributed from the business to the business owner, to Bob. This is his K1. Or to Sue, this is her K1, either way. Plus 4C is total guaranteed payments to Bob or to Sue. And these, of course, are individual. Each has, even though they're a married couple, now they each have their own K1s, of course. Minus box L, what did Sue contribute back to the business, if any? And that's the formula. Okay, now, you have, let me just ask the question, Kobe, what's the most business entities you've seen with a borrower? In other words, we've been using the example of Bob and Sue throughout today's session. They own one business, ABC LLC. Have you had clients that had 4, 5, 10, 20 different businesses? Kobe?
The most I've seen is 4,
4.
but
Okay.
I've heard of someone seeing a lot more.
Oh yeah, 20 or 30. Thank you. So
Mhm.
4. Heather, how about you? In your world, what's the most you've seen where Bob and Sue own these businesses? Roughly. Okay. Anar, how about you? Anar, what's the typical you've seen, the max, like 10, 20? How many have you seen of your clients?
I would say 3 to 4.
Okay, just 3 to 4, no problem. Michelle, how about you in your world? What's the most you've ever seen?
Yeah, I would say about 4. We don't see
4?
too many.
Okay,
I
okay,
think
all right.
Shakita's seen a few more than that.
no problem. And Shahida says 3. Okay. Now, let's say you have 3. Let's say you have 3. Bob and Sue own 3 businesses. Well, we need to do this same analysis it would be for 6 K1s. Where'd you get 6? Well, let's say Bob and Sue each, this couple, they each own, each have ownership in the 3 businesses, the 3 LLCs. Well, 2 K1s apiece times 3, 6 of them. So now you're up to 6 K1s. You've got to do this math on all 6 of them and then do a cumulative total. Now, what is your worst nightmare on planet Earth? You do this formula for 5 of the 6 K1s. And for some reason, Jane did not send, maybe she missed it when the email, remember we talked about maybe there's a tax form missing or whatever. In this case, the K1, or for whatever reason, we only have 5 of the 6. We call up Jane, the CFO, and she says, oh, that 6th one, there's nothing on it. As soon as you hear that, my personal opinion, in my mind, I would say, we need that 6th one. When the customer starts saying, you don't need that, well, that's when you need it, most likely. So you've done the running total on the 5 K1s for the 3 businesses, because you're missing the 1 because there's 2 each. And your running total, line 19A plus 4C minus box L capital contributed, is 200,000 positive. You're going, oh, that's great. What is your worst nightmare? The 6th and final K1 comes across. Jane finally scans it and sends it to you. And you pull it up, it's pulling up on your screen, and you are just beside yourself. Why? 19A capital distributed, 0. 4C guaranteed payment to partners, 0 for this particular 6K1. Capital contributed 200,000. What? Your running total with the first 5 K1s is 200 positive. Combined with the 6, the negative 200, you're 0. You wipe out that part of the cash flow. What's even worse? You get that 6K1. 0 distribution, 0 guaranteed payment to partners, and not 200,000 contributed, 400. 400, a minus 400 plus the positive 2. Now you're negative 200 with your cumulative. As I mentioned earlier, even though this is on the business tax return, we use this formula, we use the ending cash figure and insert it back on page number 5 in our main PowerPoint in the personal cash flow for Bob and Sue. Just a thought. But I've done this. I had the most I ever had when I was on your side of the table. I had a customer of 65 K1s. Whoa. And it wasn't because of a married couple. It was, he personally had ownership in 65 businesses. So there's just one K1 each, because it wasn't with his spouse, no. And the CFO emailed me the whole stack of K1s. And we're missing the last one, the 65th. Believe it, this is true. Not 3, that goes to 6 and you're missing 1, because of double each. Bob has 1, Sue has 1, so there's 6. No, this was 65. I called the CFO. I said, I need the 65th. She says, oh, no, you don't. And she was a friend of mine. I used to work with her. We used to work together at the bank. I said, Teresa, I need that 65th. Oh, David, I'm just going to tell you, they're all blank. It's just zeros. I thought, okay, I trust Teresa. I really did. I still do. I still trust her. And I said, Teresa, I need that 65th. I need the 65th. Okay. She sends it over. Thankfully, she was telling me the truth. It was all blank or it was all zeros or whatever. Oh, shoot. Dodged a bullet. Moving forward. Now let's go to the 1120S on the S Corp. We're going to bypass the cash flow and stay on the theme of the K1. So if you go in to this second, the K would go all the way forward about 5-6 pages to the K1 for the S Corp. It's a little different form, as I mentioned earlier. Okay, here we go. Bottom left-hand side of the page, do you see for IRS use only? Let's just use that little blank spot. There's nothing to do with that. It has nothing to do with the IRS. We're just using their form or just using the space. The formula for the cash flow. And once again, this is for the S Corp 1120S, and this is inserted also on page 5 on the top of that cash flow, back on page 5, personal cash flow for Bob and Sue. The formula is line 16D minus capital contributed. It's line 16D. You don't see the letters because it's not populated with numbers. Minus how much they contribute back. Okay. 16D, let's say it's 100,000. Okay, you see it right there on the form, but where do you find the capital contributed back? Like on the LLC K1, it's under box L, capital contributed on the bottom left. Well, this doesn't have it. So you have to ask, I would ask Jane, the CFO controller, how much did Bob and Sue, or this is Sue's, how much did Sue, if any, contribute back to the business? Well, her distribution we see is 100,000, 16A. Jane confirms it. This is where we have to believe Jane. There is no real documentation per se. That gets back to the C, the 5 C's of credit, character. She says, no contribution. Okay, fine. Positive 100. That 100 positive, 100,000 positive goes into page number 5. Back in your main PowerPoint to your left, pardon me, the personal cash flow. Now, any questions on reading the K1s? I find with a lot of lenders, whoa, this sometimes is all different interpretations. Haley, can you type into the chat? Any questions on reading the 2 different types of K1s? Well, any questions on this? No questions so far. Excellent. Kobe, any questions on the K1s, please? Any questions?
Yes, can you just repeat how you, the figuration again for the cash flow on this?
Okay, for the S Corp, right? Not the LLC, but this one. Okay, it's, no problem, will do. 16D, it's a line over on the far right, 16, and if we had the codes, it would be lines, or 16D, capital distributed from the S Corp. Let's say this is Sue's K1 to Sue, minus how much, if any, she contributed back to the business. Okay. But nowhere on the form does it show it, like on the LLC K1. There's box L at the bottom left that says capital contributed back. That doesn't exist in this format of the K1 for the S Corp. So that's why we have to ask Jane, the CFO controller, to confirm. Oh, we see, and I'm just making up this number. Oh, we see that Sue took 100,000 distribution. Okay, it's 16D. But Jane, can you please confirm, did she contribute anything back, which becomes a negative? The distribution from the business to Sue is a positive. Well, did Sue contribute anything back? That's a negative. We call Jane. Jane says, I can confirm nothing. She contributed nothing back. So what is your cash flow from this K1? 100,000. Where is it inserted? Back on your main PowerPoint, page number 5, personal cash flow at the top. Now, what if in this example, oh, no problem. Thank you, Kobe. You're welcome. What if in this example, the distribution was 100,000, but Jane says, oh, she contributed 50,000 back. You would take 100,000 minus the 50, gives you 50,000 as true cash flow from this entity to Sue. What if the distribution was 100,000, 16D? But what if the contribution back was 200,000? The net is a negative 100. The negative 100,000 would be inserted on page 5 to the left of you in your main PowerPoint at the top. Ooh, that's going to hurt. Now let's go back. Let's hold your eyes. I'm going to go back, just turn back about 5 pages to the front of the S Corp. Okay, now let's do the cash flow for the business. All we did was we spent time right there on the 2 K1s for really to finish up the personal cash flow back on page 5 in your main PowerPoint. And I always like to just do the K1 for the LLC partnership and then for the S Corp because they're both K1s and they're a little different, just to kind of have that whole discussion. So the cash flow is similar to what we did on the partnership or LLC. You'd highlight line number 21, net income or net loss. Add back line number 13, interest. Line number 14, depreciation. So line number 21, add back 13, add back 14. On line number 19, I highlight that. Over to the right, amortization with the question mark and then C statement in the back of the return, C statement. If it exists, it won't be here, it'll be on the back. And then lastly, add back line number 15, depletion. If you look to the left of you on page number 9, the standard EBITDA formula without the T, because this is an S Corp, without the T, standard. Now, before we forget, please on line 12, slash through the word taxes. Remember, that's property tax. That is not the same as income tax. Now, if you'll move forward to the C Corp, the 1120, move forward about 6 pages to the C Corp. The 1120. Okay, now, this is a freestanding business relative to tax. So there's no K1, no pass through and all that, no way. If you would highlight with your pen, actually slash through, I should say, not highlight, slash through, line number 17, taxes. This is property tax. Okay, well, it's the formula. Well, look to your left, earnings before interest, taxes, depreciation, amortization, depletion. The formula is as follow. If you would highlight and then I'd put the code off to the side or at the bottom of the page, please. Line number 30 minus 31. Line number 30 is taxable income minus the total tax. 31 gives you net income or net loss. Add back earnings before interest. Add back line number 18. I'd highlight that. Taxes, line number 31. Depreciation, line number 20. Line number 26, amortization, C statement in the back. I'd add that to your notes. And lastly, line number 21, depletion. Same exact formula, pretty much. Line number 30 minus 31, earnings. before interest, line number 18, taxes, line number 31, depreciation, line number 20, amortization, if it exists, 26, but we're gonna go to the back. Either statement 1, 2, or 3, and lastly, line number 21, depletion. Some commercial lenders do it this way, a little very little variation. They start with line number 30, taxable income. They don't take out the tax, line 31, but they don't add it back in either. And they'll get the same number. You said, well, why do we take it out just to add it back in? Well, just to clarify, it's truly net income. And then later add the T of taxes back because they're non-operating expenses, as we discussed earlier. But either way, if you start with 30, don't take tax out, 31, or add it back in, you'll be the same. Add backs up above. If you take 30 minus 31, and then eventually add back taxes as well as the other items, you'll come up with the same number, same analysis. Now, moving forward, let's turn forward, if you will, to some live examples. And I'm just going to point out a few little tidbits, if you will, just a few little items. First off, it's 1065. We'll start with the LLC, then go to the S Corp, then the C Corp. Same order we've taken in the previous part of this exhibit too. Look at this. At the top of this, do you see final return? Obviously, this is in the middle top under number 2, right below the box. Just a thought, just a thought. Boy, you see final return, it's like, whoa. Or it could be box number 1 to the left of that, initial return. Just kind of interesting. I just thought I'd point that out. Moving forward, turn forward on this LLC partnership, if you would, please, to the balance sheet. Do you see the balance sheet, page number 5? Just flip forward to page number 5, please. Now, look at Schedule M1. Do you see where it says per their books, a negative 18,288? Well, that's got a balance to that company prepared financial statement. Absolutely. Moving forward, let's look at the first of several K1s, just the first one. Now, look with me. Look at the formula. This is on the K1 for the LLC or partnership. Same thing. Look at the formula. It's 19A distribution, bottom right-hand side, 1789, plus guaranteed payment to partners, 67,720, minus, and that's 69,509, minus box L at the bottom left. You see capital contributed is blank, 0. So the true cash flow from this entity to the principal, let's say this K1's to Bob, is 69,509. Now, look at the top. Look at box 1 at the very top middle of this page. For tax purposes, this is the negative 825. Do you see that? $825. Because this is the dollar amount that's going to flow over to the Schedule E for Bob and Sue. But for tax purposes, it's a negative 825. For cash flow, it's a positive 69,509. That's totally different. George, remember the CPA, fixates on tax. We fixate or focus on cash flow all the way. Let's move forward. Hold your eyes. You see, here's a page with the description of the various, the various parts of the K1 with the letters. Now let's go to the 1120S. Live company. Moving forward. If you'll turn with me forward on this. Turn forward about 5 pages. You'll see Schedule M1, Schedule M2. Now let's look at the one and only K1. Whoa, whoa, whoa. So just fast forward about 6 pages to the only K1. Well, how do we know this is only K1? Well, the giveaway is under Part F. Do you see where it says 100% of the stock ownership? So there's just one shareholder. This is Sue's S Corp. Now she's married to Bob and they have ABC LLC, well, that's fine. They can have multiple businesses. She has some, he has some combined or whatever. Okay, now just to highlight this K1, the cash flow is line number 16D minus how much Sue contributed back to the business. Well, look at 16D, it's not there. In fact, if you hold your eyes, if you turn down 16C, non-deductible expenses, well, no, we want C, we want 16D distributions. Well, so going back to this K1, the distributions on this are 0 from the business to Sue. Plus, or probably not plus, minus what she contributes back. If she contributes 0, it's all 0, 0, 0. But what if Jane confirms, oh no, her distribution 0, there's not 16D. Oh, but she did contribute 25,000 back to this business. Well, what is the ending cash flow on this entity? A negative 25,000 that would flow back to page number 5 on your main PowerPoint. Absolutely. Look from a tax standpoint. In that example, it's a negative 25. I made up those numbers. Look at this. From a tax standpoint, it's only a negative 5405. Sometimes the cash flow is worse than the tax as far as the raw number. Other times, oftentimes it's the other way around. The cash flow is better than the related tax or taxable income, I should say. Moving right along. Now turn forward. Look at the statements. Pardon me. Remember we said we'd look in the back, statement 1, 2, and 3. Well, in this example, there is no amortization. Just thought I'd point that out. If it existed, probably be under statement 1. Now let's go to the final, the 1120, the C Corp. The 1120, which is the C Corp. Okay, now what I'd like everyone to do is grab your cell phone, if you would, please, and calculate the EBITDA cash flow for this C corporation. Now, don't worry about 29B, the special deduction. Just I'd slash through that, please. Don't worry about that. Okay. And also, line 17, do you see where it says taxes and license? No, I'd slash through that, including the number. You're not going to add that back. No, because that's not income tax. That's property tax or some other form of tax. Go ahead, use the basic EBITDA formula to the left of you on page number 9. Grab your cell phone or a calculator and calculate what is the EBITDA for this business, the inflow. Go ahead, spend just a moment on this, please. Take just a moment. Okay. Anar, what's your ending number? Anar, what's your ending number, please?
I'm still working on it.
Keep going, keep going. Spend some more time, everyone. Spend more time. Just, I would look at to the left, look at page number 9 in the main PowerPoint and just use that as a guide. Absolutely. The format. And remember, line number 9 or line number 17, no way. That's other tax. Remember that. Okay. So we don't add that back in. No way. And line number 29B, that special deduction, just no, don't include that. I'd cross through that too. Okay. From the chat. Okay. All right. Michelle, what number did you get? Did you get the number yet?
I'm getting 43,000.
How much again?
43.
43,000, okay. No, whoa. But don't include that 13,000. You included the 13, right? The 13 on line 29B, 29C as well. Don't include that. Okay. Shahida, what did you get? Let's see in the chat. Let's see if we've got hers. Shahida says 30,000. Okay. Shahida says 30,000. All right. All right. Haley, what did you get on the number? What did you get on this number? If you can type that into the chat, please. What's your ending number? Okay. Okay, she's redoing it. We'll give them a minute. Just give them a minute. Let's go ahead and we'll walk this through, if you will. Give Haley another minute or so. Okay, Kobe, what's your number? Can you give us your number, please?
I'm still working on it.
Keep going, keep going.
Okay.
Like I said, do not include 29B, 29C. Do not include taxes on line 17. No, just follow the format, if you would, of the cash flow on the left. Okay, Heather, what number did you get? Can you tell us?
I got 30,000.
30,000. Okay, the correct answer is 30,000. Excellent. Several of you got that? Let's walk through this together. Okay. You take, if you follow the format, you take line 30, 20,000 minus line number 31, 4,200. And then you add back earnings before interest, line number 18, nothing. Taxes, line number 31, 4,200. Depreciation, 10,000, line 20. There is no amortization, line 26 in the back. And lastly, add back line number 21, depletion, which is blank. We don't add back 29B, as I mentioned, that's an adjustment. We do not add back line number 17, taxes and license. That's other, that's not income tax, as I mentioned earlier in previous example. Now, once again, if you started with line 30, you had you had line 30, you don't take out the tax, but you don't add it back in. You go from line 30 and you add back line number 18, interest, line number 20, depreciation, line number 26, amortization. Some of these are blank, of course. Line number 21, depletion, blank. You'll arrive at 30,000 as well. Any questions? Anar, any questions on the math? Any questions on this case study?
No,
Okay.
I did this taxable income 30 and plus depreciation.
Oh, gotcha. Okay, got it. No problem. Michelle, any questions before we move on? Any questions?
No,
Michelle?
okay, thank you.
Okay, thank you. You bet. You're welcome. Okay, now, everybody, let's stop. Take exhibit 2, if you would, please, and put it off to the side. And then if you'll just move the main PowerPoint over right in front of you. And give me just a second. I'm going to go back to the main PowerPoint. Give me just a second on this. Okay. All right. Now, you should see that. We're back on the main PowerPoint. Okay. Kobe, can you see the screen? Can you see we're back on page number 9?
Yes.
Okay, good. Thank you for doing the check for us. So we've done this cash flow model for the 3 types of businesses, and we did the K1s for 2 of the 3. We did page number 10. Let's now move to page number 11, our final cash flow for the day. Global. All it is a combination of the 2, nothing to do with international banking, international trade. It's simply just a combo or a combination. What is the minimum DCR nationwide standard? I put this right next to the 2.21, 1.20. For every $1.20 of inflow, there's a dollar outflow. Now you can see business cash flow, personal, just like we've done, and then the combined margin, combined DCR. Well, if you had a 2.21, that's strong. For every $2.21 of combined cash flow inflow, there's a dollar outflow. At a 1.20 minimum, wow, 2.21 looks pretty good, very good. Now, let's turn forward. Section number 3. Section number 3. This is our little miscellaneous section. We'll take this, we'll take our last break, come on back, do exhibit 3 and get you on your way for the evening or the afternoon. Okay, here we go. 3 sections in miscellaneous, section 3. 3 areas, I should say. The first is the tax code overall. We talked about this extensively. The US Congress makes the tax code. The IRS manages the process and enforces the collection of the cash. But look at this. It changes. It changed radically 1/1/18 with the TCJA, Tax Cuts and Jobs Act. But the numbers, the overall models stay the same. Even the depreciation formulas, as I mentioned earlier, the section 179 went from a little over 500,000 to $1 million, doubled. So the numbers changed, but the overall format didn't change. Technology. Okay, we're going to do a class shout out. Everyone, if you'll unmute yourself and the people in the chat, if you'll type in yes or no. Pardon me, have you ever e-filed a tax return? It's obviously the wave of the future. Absolutely. More and more. Everybody, yes or no, please.
Yes.
Okay. Any more yeses, any more nos? Go ahead, please. Everybody, if you'd unmute. Have you filed a tax return, e-filed?
Yes.
Okay, we've got more people. Excellent. For those in the chat, Haley says yes. Shahida says yes, absolutely. Once she says, okay, good. Thank you, everyone. Modern, of course, direction of the whole system, tax system. Let's turn to page number 13. We've alluded to this before. Fraudulent returns. Look at the tax cheat on Time Magazine. I love it. That's why I grabbed that off, the clip art and pop that on there. Absolutely. Could this happen to you at your bank? You have a client, like I had once, negotiated a business loan, commercial loan, a couple $100,000, not a big loan. And at the end of the negotiation, he gave me all his tax returns, all his financials, everything. At the very end of the negotiation, that first meeting, goes, well, by the way. And he stood up and we shook hands. This is pre-COVID. And then he turns to leave and then he turns back and he goes, by the way, David, if these tax returns are not strong enough for your cash flow modeling, he said it just like this, for your underwriting, your cash flow modeling, whatever. He says, you just call me and I'll have my runner bring a separate set down to your bank. And I thought he was going to start laughing. I'd laugh. He was serious. Needless to say, we did not do the deal. Now, jumping down to number 2, what happens if you do suspect fraudulent returns? We are not, I beg of you to put below number 2. We as a bank are not the agent of the IRS. Some bankers, some lenders get confused and think, well, we must be the agent or the extension of the IRS. Oh, no, we're not the government. The bank is not the government. Oh, we're regulated by the government, but we're not the government. We're not the IRS's agent. In fact, the truth be known, sometimes your bank and the IRS are bitter enemies. What? Bob and Sue default on a $3 million commercial real estate loan. And there's a ton of equity in this building. Okay. You foreclose on the building as the bank, as the lender. And the IRS, boy, they're coming after them because they're defaulting everywhere. The whole company's going down financially. They're gone. They're bust. Bob and Sue are. The IRS is going to probably lean that building to try to recover something. And they may fight your bank. I am serious as a heart attack. You're going, no way. Oh, yeah, they will. The IRS is not your bank's friend in any way, shape, or form. Now, having said that, we expect our clients to be truthful, in other words, not fraudulent returns. So that's really a separate issue. We want them to adhere to the tax law or the tax code, absolutely, and not give us two sets of returns, and we'll use the better of the two and just shred the rest or whatever. Look at number 2 up above. Numbers don't add up right. What about number 3? Unusual level of deductions. Now, once again, we're not the agent of the IRS, but to get a feel for, man, are these guys going to get in trouble with the IRS? And therefore, it will impede their ability to repay our loan. That's the big issue. We may even call George. We may call Jane. Oh, these numbers don't look right. Or George. Well, call George, Jane says, because he prepared the tax return. And maybe there's a clear explanation. Maybe there's not. Under number 1 down below, listen to what the customer tells you, what they don't tell you. Huge. Okay. No names mentioned, no details. And not even your bank, because you may have worked at several different banks over the years, or at least a few. Michelle, have you ever seen a fraudulent return that at least you suspected? Don't give us names, don't give us details. We're not even at your bank per se. It could have been other bank or whatever. But have you ever seen it in your career, Michelle?
I think I have maybe a few times.
Okay.
Yeah.
Yeah. And Michelle, how did you know? Well, if you're like me, it's my gut. I know that sounds weird, but it's my gut. What about you, Michelle? How did you know? Was it the numbers or was it your gut that told you that?
Yeah, it's kind of a combination of both, but definitely your gut will tell you first. And then
Yeah.
when you start asking some questions, in the right way, other things can come out and it will not seem correct.
Good. Excellent. So maybe the numbers first, but who in the end you're feeling, and you start asking questions, and then your gut really tells you, oh, there's something wrong here. Thank you, Michelle. Excellent example. Excellent. The last section of this little miscellaneous section 3. Marketing. What? Okay. I'm going to ask a few of you. Do you do any marketing in the bank? Or are you pure, simply technician credit? You're crunching the numbers, that's it. You have no marketing responsibility. Shahida and Haley, if you'll type into the chat, do you have any marketing responsibility in your current position? And while we wait on those, Kobe, how about you? Do you have any marketing responsibility currently in the bank?
Not really per se.
Okay. So not per se. So you're not asked to go ahead.
Well, I guess yes. Outbound calls, yes.
Okay.
Marketing
Phone calls and a few things. Okay.
Yeah.
Thank you.
Yes.
Thank you for that. Heather, how about you? Heather, do you have any marketing responsibility at all?
No.
Okay, you're pure credit, pure crunching the numbers. Is that right, Heather, or not?
Yeah.
Okay, good. All right, now let's ask, okay, we've got Shahida, no marketing responsibilities. Haley, no marketing. Okay. Now, I don't mean to speak out of school, but I will say this. Depending on how long you stay with the bank, how long you stay in lending, statistically, most lenders over time are asked to do more and more marketing. Now, some of you may say, ooh, I don't want to do that. I don't want to be shaking Bob and Sue and Jane and George's hands or elbows or fist pump or whatever in the era of COVID. Some of you say, oh, I don't mind that in the future. Give me another couple of year or two in in the credit analyst position and really crunching the numbers, and I'd like to do that. It's just your preference. There's not a right or a wrong to it. But let's say you are asked down the road, a year from now, 2 years, 3 years from now, to do a little marketing. The tax return, believe it or not, can be used to further market your bank. Look at this first one, marital status. You know the marital status of the couple, if it's a couple. What if you've been banking Bob? This is just a hypothetical. For the last 18 months, gave him a car loan, had him open a checking account or a savings account or a CD or whatever. One day you're looking at his tax return and you go, and you know he's married, but you didn't really pay attention to his wife's name. Well, all of a sudden you're looking at the tax return. His name is Bob Smith. Her name is Sue Jones. And you look at Sue Jones and you never realized she goes by her maiden name. And you say to yourself, wait a minute, could this be the Sue Jones that owns Jones wholesaling company, huge wholesaler? They work with distributors all over the nation with certain products, mainly tied into plastics. Wow. Her operation's just on the edge of just, about 2 miles from your bank or your branch or your office. Could this be this? And you as a bank have not been able to get through the front door. You always get blocked out. Can't even get an audience. From a marketing standpoint, I'm referring to. All of a sudden, 15 minutes later, Bob walks in your office, in your branch or your office. Bob, after he makes his deposit, hey, do you have a minute? Oh, yeah. Bob, you sit down, Bob. I don't mean to sound strange, but is your wife the Sue? And you can't even see Jones. And he goes, yeah, Sue Jones. Yes, she goes by Sue Jones because she was raised in the business. He says, my father-in-law passed away a couple of years ago. She runs it. Everybody knows her as Sue Jones. And you can't even blurt it out. Can we have an audience? He goes, oh, do you want to meet with her? And he's already texted her and he goes, can you be there tomorrow morning at 9 a.m.? Whoa. You have spent months trying to get through the front door to get an audience with the owner. You didn't even realize you're banking the owner's spouse. What? It does happen. I promise you. We get busy. Everybody gets busy. We miss things. Dependents. Let's shift back to the Bob and Sue. That we know both Bob and Sue, and Jane and George, the CPA, Jane, the CFO. Tax return is going to show you. They got 2 dependents that are not under 17. They're not checked. Oh no, they're over 17 or older. So they don't get the child tax credit. Wow. Wow. You say to them, Bob and Sue, hey, how are the kids doing? Where are they at? College. Do you need a product? Do you need debit cards? Do you need an auto loan form? Do you need this? Do you need a new checking account? What do you need? It's just using the tax return. Look at number 3. Determine where your customer's at on the life cycle. Depending on their age, to a large degree, we're gonna on that last little question, how do we fit their needs? The tax returns can tell us. One other thought, we move on. Okay, now, most of commercial lenders, we don't touch Schedule A, whether or not they file it, or if they do standard deduction today, the higher of the two, like we discussed extensively. Schedule A, this is just a thought. If you do have a Schedule A, you see how much interest they pay on their home mortgage, right? 8B or 8A is the part of the form we covered earlier. You say to Bob and Sue, well, what rate are you on? It looks like you're paying a lot of interest. And Bob says, oh, I've been so busy. Sue and I kept talking about it, but I kind of dropped the ball. Well, what rate are you at? Well, we're at 4.5. What? We can give you 2 3/4 or something a lot better than 4.5. And we'll be very fair with you on the fees, Bob and Sue. Wow. Tax returns used to further market your bank. It's a concept that most lenders, you don't think about. Just a thought, just a thought. Moving right along. Here we go. Page number 15. In conclusion, tax forms we've covered, personal and business, cash flow, personal and business, other issues, miscellaneous. And now, everyone, if you will put the main PowerPoint to the side and take out the third and final exhibit. The third and final exhibit, if you would, please. If you'll take that out. Okay. Give me just a second. I'll pop that up. Here it is. Okay. Give me just a second. Here we go. Okay, boy, it's doing it again. Hold on 1 second, everyone. Give me just a second on this. Okay. Some reason, give me just a second. Let's go ahead and do this. Let's take our last 5-minute break and I'll have this back up and running. So everyone, let's go ahead. If you go ahead, just take a 5-minute break. We'll come back and we'll do this last exhibit. Thank you, everyone. Welcome back, everyone, for our last little section. Take just a moment, we'll get started. Okay. Michelle, are you back with us? Can you do our sound check, please?
Yep, I'm here.
Thank you so much. And I was able to get the screen up for some reason, just the last little bit, and that happens with Zoom. You know, sometimes it will lug and not allow you to get the share the screen, if you will. Now, you should have Exhibit 3 right in front of you. We're going to go through this to summarize, and then we're going to do a quick activity and get you on your way for the day. So if you look with me, page number 2, the page numbers are on the bottom right-hand side of the page, little page numbers there. This will start with the TCJA. This is kind of the recent history of tax changes in the tax code. This was of 17, kicked in 1/1 of 18, as I mentioned earlier. I'd highlight Part A and Part B. We talked about this earlier. Standard deduction nearly doubled. Personal exemptions eliminated. Turn to page number 3. Under Part E, I would circle that whole little paragraph at the top. This is what we talked about, the QBI, or qualified business income, the 20% pass-through income tax free. Then if you'll move forward with me, page number 4, we talked on Part G, the concept of divorce and tax, and really the significant change. Under Part J at the bottom of the page, if you would highlight that one or circle that one, the doubling of the child tax credit, but it's even more, as we'll see, even further increased just recently. Now for page number 5, still on the TCJA. Look at Part L. We did not discuss this. I would highlight all of Part L. Home equity loan, home equity line of credit. If your bank provides it, some of your banks do, some of you don't. It used to be no matter what the line of credit was used for, the interest would be tax deductible. It could be used to make improvements to the home, like a new roof on the house, send the kids to college, go Bob and Sue take a cruise. Oh, fully tax deductible. The interest that generates or that is accrued on that line. No longer. Look at this. It's repealed, except with one exception. Substantial improvement to the property, meaning the primary residence, a new roof, a new kitchen, a new addition, pardon me, to the back of the house. Interesting. Look at Part P. Part P at the bottom. If Congress does not act, most of the provisions of the TCJA will expire in 2025. I'd highlight or circle Part P. For example, the Section 179, that's now $1,050,000. It was only $500,000, went up to $1 million, then ratcheted up to $1,050,000, would go back down to $500,000. Seriously, this is significant and a moving target. And I'll say this straight up front right now. I strongly recommend that each of you take a tax class once a year, whether it's from the Michigan Bankers Association with me or somebody else, or some other instructor or whatever, but as long as you get the tax updates, because this is, as we mentioned or alluded to earlier, an evolving process, if you will, including from the US Congress. Page number 6. Now, this happened, this law, which was the consolidated 2020, what have you, the highlights, right next to highlights, I put December of 19 was put into law, signed into law. Just one of the items, look at Part C down below. PMI, private mortgage insurance, remains tax deductible. You pay that on your mortgage, boy, still can deduct that. Page number 7, the Secure Act. This was put into law, signed into law. I'd put next to highlights, please. Also December of 19, and quote unquote kicked in January of 20, but this is still pre-COVID. So January, this kicked in or became law January of 20. Now, the spirit of this is to promote more retirement planning. Look at Part D. I'd highlight Part D, part-time employees. Traditionally, part-time employees have not been able to participate in the 401k. But now, look at this, under certain parameters, certain circumstances, they can. Promoting more and more retirement planning. Now for the CARES Act, 2020. This was, I put highlight spring of 2020. Look at this, charitable contribution and deduction. Well, if you do a standard deduction, you don't itemize, you don't get that charitable contribution. Well, to promote helping charities in the pandemic, this was $300. Now we're going to see it in just a moment. Now it's $600. Look under number 10, or pardon me, under Part C, 10% penalty waived on an IRA that is broken, if you will, or you know, basically they take it and open, you know, basically withdraw it early. They're below 59 and a half. No, penalty is waived. Size of the loan on the 401k, NOL we'll come back to on, we talked about briefly, we'll come back to in a minute, Part F. With the CARES Act, massive changes, temporarily in theory, to the tax code. Page number 9, now I'd highlight December 27th of 20. Now this kicked in or became law 1/1 of 21. So January of 21. Look at Part B. I would highlight Part B. Extends many of the provisions of the CARES Act all the way to the end of this year. Part C is one that literally blows the mind of certain CPAs and tax professionals. I still am shocked by it. Well, what is this? Okay, before we do this, I need to ask, Michelle, have you touched any PPP loans?
Yes and no, if you define what you mean by that.
Well, in other words, have you processed any? Have you worked with clients on any of these?
Normally I don't, but I did help out during the
Okay,
initial process.
Okay, no problem. A lot of lenders have touched PPP. Thank you for that. Kobe, have you touched the PPP at all? PPP loans?
No,
Okay.
no, we have not.
Okay. A lot of lenders have. Oh, and they're full. Oh, they are really, they don't want to do anymore. Oh, it is horrendous. It can be. Now, from a tax standpoint, look at Part C. The forgiven portion of the PPP loan is not taxed. That's one benefit. But at the same time, look at the second line down under Part C. The amount of money that matches up to the forgiven portion that was used, the expenses of the business to justify the PPP forgiven portion, is not tax deductible. That's a double benefit. You're not taxed on it up above, and down below in the expenses, you still get to write off the expenses. This is unheard of in not just modern, but entire US tax history. Oh, this is like, what? I had CPAs towards the end of 2020, and I said, well, this is starting to come out. I'm seeing articles saying this will probably happen. Oh, it'll never happen. Well, it did. Double benefit. Wow. Look at Part D, $600 for charitable deduction. PMI under Part E is still tax deductible. And look at under Part F, the meals. Traditionally, meals are limited to 50% write-off. So if you take a client to lunch and you pay for both plates, well, the bank's only writing off their plate, not your plate. Now it's fully deductible, both plates. Congress literally put Part F into play or into place. In December, and then the president signed it with the full intent of helping the restaurant industry survive or recover, maybe not survive is the word, but recover from COVID-19. Seriously. Page number 10. The latest American Rescue Plan is the law. I would highlight 3/11 of 2021. President Biden signed this into law. This is the most recent tax update in the US today, right now. But there is no more updated than this. I promise you, there's none. Now, look at the child tax credits under Part B. I mentioned that. And they may even be $300 a month per child actually come out, not a credit at the back end of the tax year, but now cash. $3,000 for children aged between 6 and 17. Wow. Now, if you would, to the right of ARP, the Biden administration has 2 additional proposals. Now, whether you want these or not, I'm the reporter. I'm just reporting so that you have a feel for what is proposed. So to the right of ARP, if you would please put American Jobs Plan. American Jobs Plan. And then to the right again, if you'd put American Families Plan. American Families Plan. Okay, now, these are proposals. The first, the ARP, American Rescue Plan, that's the law. That is the law of the US. I promise, that's the law. These other 2 are proposals. One of the main features of the American Jobs Plan is infrastructure. One of the main features of the American Families Plan is free college education for 2 years community college. The initial dollar amount for the American Jobs Plan by the Biden administration, 2.3 trillion, 2.3 trillion. By the way, before we forget, the ARP was 1.9 trillion. That's done. 1.9 trillion done. So 1.9 trillion, 2.3 trillion, and go to the right, American Families Plan, 1.8 trillion for a total of $6 trillion. Now, in the last couple of days, the Biden administration has taken the 2.3 trillion on the middle one, American Jobs Plan, and lowered that to 1.7 trillion. The Republicans are saying, well, we want 568 billion. If it's 1.7 trillion, the combined of the 3 packages, 5.4 trillion instead of 6 trillion. I'm not commenting on the politics. I'm not commenting good, bad, indifferent. The first one to the left is law. The next 2 are proposed. Here are 3 ways that the Biden administration, or at least, proposing to pay for all of this, for paying for these bills or this infrastructure and all this. Number 1, on the corporate tax rate, going from 21 to 28%. 21 to 28%. Capital gains, we talked about capital gains, but on the rates, adding a top tier, going from 20 to 39.6%. 20 to 39.6. And lastly, the individual tax rate, the max right now is 37, going up to 39.6. 39.6. And there's several others that are, just kind of been floating around or floated around. I'm not commenting good, bad, or indifferent. I'm just stating what is been put out in the press per the Biden administration, at least from what I've seen. Whether or not package 2, package 3 makes it, or the dollar amount, who knows? Who knows? Let's move forward. These next 2 are just the tax brackets. You can see on 2021, 37, there'd be a 39.6. Page number 12. Turn to page number 13. We did the standard deductions and personal exemptions we talked about. Moving forward, page number 15. Capital gains. There, instead of the top tier of 20, it'd be 39.6. Section 179 on page 16, we discussed extensively. Moving forward, net operating loss. I mentioned it's not a positive nor a negative when it comes to cash flow. But look at the bottom under CARES Act. all I can tell you is this is massive flexibility. If a business has suffered millions of dollars of losses in 2020 because of COVID, the CPA or tax preparer could go back to 19 when they made a lot of money, paid a lot of tax, 2018, 2017, what have you, and file amended returns, taking the losses for 20 and going back and recovering additional tax refunds. This bottom note is huge for certain industries. But not all industries have been decimated because of COVID. Like the residential industries, whoa, it's huge. It's up in construction. It's like, whoa. But other industries are decimated somewhere in the middle, kind of just in the middle because of the pandemic. Turn forward to our last page, page number 21. We talked IRA at the start of the session, including the catch-up provision of $1,000. We talked about the 401k 19.5 plus 6,500 catch-up provision and the self-employed down below. Okay, now we're going to do a quick activity and then conclude. Everyone take just a moment. Go back in the material, the main PowerPoint, even the 3 exhibits you can look through. And there's no right or wrong to this, but what are just 1 or 2 takeaways from today's class, today's session that will benefit you? That will benefit you as a lender, as a credit analyst, as a loan officer, whatever. What are just 1 or 2 concepts that will benefit you from today's material? You know, and it doesn't have to be, pardon me, it does not have to be a major model. It could be just one little thought, one little idea. We covered personal business forms, tax forms, personal business, cash flow, miscellaneous, and then the tax updates. Go ahead, and if you're in the chat, boy, Shahida and Haley, if you'll go ahead, they're already putting it in there, Okay. Take just another moment, and then we'll summarize with this. There's no right or wrong, so don't hesitate. It's just, boy, just what just really stands out in your mind. Okay, here we go. We'll start with Haley. She says, difference between what the client might say and what their taxes might say. Oh, I love it. Excellent. Shahida, better understanding of Schedule E, that was the rental and so forth, and the tie-in with the K1s and the royalty, and Schedule F. Excellent. Good. Okay, now, Kobe, how about you? What's 1 or 2 thoughts, takeaways from today's session, please?
Just a better understanding of the difference between the personal and business tax returns and,
Good.
and
Go ahead.
what to look out for.
Good. Good. Especially in the cash flow models we went in depth on, right? Excellent.
Correct.
You bet. Thank you. Heather, how about you? What's 1 or 2 ideas, takeaways? Heather, if you're with us. Anar, how about you? What's 1 or 2 ideas or takeaways?
Yeah, so calculating cash flow, I was always wondering why we add back interest.
Yep. Good.
Yeah,
Excellent. That's one idea. One segment. Good.
yes.
Good. Any
Right.
other ideas? Any other comments, takeaways from today's session that will benefit you?
Overall, I learned a lot today, actually.
Okay.
So, yeah,
Thank you. Excellent. Thank you.
thank you so much.
Oh, you're welcome. Okay. Lastly, Michelle. Michelle, what's 1 or 2 takeaways from today's session, if you would?
I think going over the K1s, we obviously work with them every day, but I think just going in depth with them a little bit more kind of gave me a better understanding of that. as well.
Good. K1s for both the LLC, partnership LLC, and the S Corp. Excellent. Anything else, Michelle? Anything else? Okay. Well, I want to thank each of you for attending for today's session. And Oh, here's another one. Here's another one from Shahida. Overall, the information will benefit me when I'm analyzing the tax returns. Absolutely. In conclusion, I want to thank you all for attending. Number one, today's session. Number two, please, as we started out, do not hesitate. Reach out to me. Send me an email if I can assist you. And lastly, number three, I look forward to meeting you all personally. You know, if we get together, if it's ground-based in September for the advanced classes, if those are appropriate for you, and or maybe some of your coworkers as well, and or some of the coworkers that you would invite. But with that, thank you all. Everyone have a good rest of your afternoon and a good evening. Good rest of the week as well. Thank you so much. Bye now. Thank you. Go ahead.
Thank you.
Oh, you're welcome. Thank you, everyone.